Fed sword has been hanging over the head of emerging markets like India, so to speak. It's not made too much of a difference to whether markets have run up.
No, it hasn't. And that's certainly to a certain extent because of the kind of earnings that the US corporate is coming out with, especially when it comes to some of the elite companies out there. Something like an NVIDIA, something like an Apple, or for that matter, Alphabet. They're all coming up with the goods, and that continues to drive the NASDAQ higher. Even in terms of, moving beyond just tech, you have a reasonably stable earnings scenario, even though there have been, warning shots every now and then talking to us about how things could perhaps get, worse down the line. Well, somehow or the other, a lot of these companies, even beyond technology, are, dishing out relatively stable earnings, and that perhaps has played in favor of the benchmark indices and the way they're going. In NASDAQ 100 is trading near a life high, as is the case for Dow Jones. So for now, of course, at least as far as the US equity market is concerned, not as much concern. But sure, and I reckon that to a certain extent, these markets are still factoring in, even if it is the case of just one price, cut, a rate hike, a rate cut at the moment. They're still factoring in perhaps a year down the line. And when I say a year down the line, even if you do see, one or two more cuts in calendar year 25, the first 3 months, will still be a part of this particular ongoing financial year. And that perhaps has some amount of impact with respect to earnings forecasts as far as FY25 is concerned, and potentially something that is playing in favor of the US equity markets.
Another interesting sort of take or point of view as far as we are concerned is the fact that this time Governor Das said very clearly and indicated very clearly that we don't perhaps have to wait for the Fed to move first.
Yes.
So if we're looking at a September sort of cut from the Fed, will we have one around the same time from the RBI? And where does it move? These are all going to be very interesting factors to look out for, that we will speak with Peter Cardillo also just in a bit as and when they get him up. Meanwhile, going back to where we're headed for the Indian markets this morning, still a 96-point up on the Nifty. The implied open is showing that we're off to a positive start, and those first rates will be very crucial to watch. Now, I reckon the action also, Agam, shifts to business updates. Those will be coming very quickly. Remember, you had an extended long result season because it was Q4, and you're going to have Q1 business updates coming in. You're going to have corporate results taking the bulk of the attention before we come back to budget.
Absolutely. And speaking of that, Tamanna, to a certain extent, we have a handful of stocks out there which are factoring in strength. Based on that, we could take a quick detour on talk about two other stocks which are on the radar today, and they were buzzing on volumes yesterday. One was, of course, Gravita India, and the other one is Elecon Engineering, and both are very much associated with how the economy is going on, and they've done well yesterday. But I think we should go back and get an expert opinion on how things have fared as far as the US markets are concerned yesterday. Well, we have Peter Cardillo, Chief Market Economist at Spartan Capital Securities, who's joining us on the show. Peter, good evening to you, and thanks so much for taking the time out. First, let's start with the inflation print that we've seen in the US. We're looking at mixed cues, at least here in India. While some economists in the US suggest that the battle against, or rather the war against inflation is completely won, there are some others who are a little bit more skeptical with respect to the inflation number. And even though this inflation number looks very good, there could be perhaps a few more challenges. What is your reading as far as inflation is concerned at the moment?
I think inflation is headed in the right direction. We had the CPI numbers yesterday, and they were very confronting in the sense that, we saw the core rate actually come in a little bit better than expected. And I think, this is perhaps the first sign that inflation is headed again in the right direction. Of course, we had it, over the past 4 months, inflation heated up. But I think this time it's going to stick. And one of the reasons that I think that inflation is going to head lower is the fact that energy prices have not really moved that very much. They've been basically locked in within a trading range. So energy is a lot that adds to the inflation at the consumer's level. Of course, salaries have gone up, but again, if you look at the wage growth over the past 2 months, they seem to be stable, and they're not moving much higher than the average that we've seen. So I kind of think that yesterday's consumers price index is indicating that we're going to see lower inflation during the summer months.
Hi, Peter. Good morning. Where we are, Tamanna here, and great to speak with you as well. I wanted to get your take on what you thought of Jerome Powell's tone and what the Fed is communicating yesterday. Some are seeing it as hawkish. Is it really hawkish, considering that they're now seeing at least a clear movement towards the 2% inflation goal?
Yeah, look, it's going to take time to get down to 2%. You know, I don't expect that, and I don't think the market expects that, and neither does the Fed expect that. But you know, once again, that the Fed took a cautious attitude, and basically, you know, if you sum it all up, what they said is we're going to view this on a meeting-to-meeting basis, which means data dependent. Yes, they continue to keep a cautious and I would say somewhat hawkish rhetoric, but by the same time, I think you know, they're ready to pull the trigger. In fact, you know, during the press conference, Powell did say, if things go our way, we won't hesitate to cut rates. If inflation should heat up again, you know, we will obviously not cut, and if necessary, we will raise rates. So it's a question of looking at the future data, not only inflation, but of course, you know, the labor market as well. And so I think even though, you know, the dot plan indicated just one rate cut, I think that's probably not going to be the case, because I feel that inflation is going to move in the right direction. And I also think that if the Fed continues to stay on this path of being data dependent, the risk of a recession in 2025 grows.
No, but one second, Peter. You said the Fed thinks that there's going to be only one rate cut. That's not what you reckon. Do you think there will be more than one this year, or not at all?
I think if we see inflation for June and July go down and head the right direction, I think we will see 2 rate cuts this year. And so we could probably see one in September, and then the next one in December.
Right, Peter. What are the immediate challenges at the moment, and what are the you know, the top considerations for the next couple of meetings when it comes to the Federal Reserve?
Well, yeah, like I said, the next meeting, obviously, they're going to probably repeat what they said today. Look, the Fed has been quite consistent. Since inflation reversed course, they've been basically giving the same message to the marketplace, and that is, we are going to be cautious. We don't want to make a mistake. They don't want to make a mistake on cutting too soon, and they certainly don't want to make a mistake on keeping rates elevated too high. The risks are on both sides of the equation. So I kind of think that, you know, it all depends on the inflation news, and obviously the labor, the strength of the labor market. And the key to the labor market is wages. If wages modestly move higher or stay around these levels, I don't think that's going to be a problem for the Fed.
Yeah. So that's the optimistic outlook, which is great. I think other houses as well have 2 rate cuts still penciled in. We'll wait and see. PPI data out tomorrow will also be crucial. Thank you, Peter Cardillo. Pleasure as always speaking to you. Before we hit that break, let's listen in to the Fed chair talking about the job market conditions, something that Peter was just mentioning. We'll come back with the F&O setup on the other side.
Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond.
I would say, as you rightly said, 2 to 3 years ago, the discounting which PSUs had compared to the private was huge. That discounting is now narrowing down. The productivity which PSUs were working with were much lower than the private, and that productivity, debatably, is pretty much as where the private is. Then it comes to opportunities which PSU have against the private. And, case in point, let's say defense. In defense, the PSUs have a lot more capacity. They're getting a lot more orders. I guess, the Indian government is giving Indian owned companies more orders, and they've become monopolistic leaders. So you can't make a generic comment on PSUs now going ahead that as a basket would do well. But what you can say is, if you can see the balance sheet and being high quality, which means no debt, good cash, if you can see an order book which PSUs have, that's in manufacturing or in defense, then you're there. Valuations a lot more as far as PSUs are concerned. For banks, are relatively still cheaper than the private, but even the private have got derated a lot. But apart from that basket,
Welcome. This is India Market Open. We are taking stock of the futures and options space and how things have fared there. Well, consolidation continues, at least as far as the Nifty is concerned, continuing to trade around the 23,300 mark. Yesterday was a day of trade where we didn't see too much, a 0.25% up move for the benchmark. And, well, when it comes to the open interest, very little change as far as futures are concerned. The Bank Nifty, we actually saw unwinding to the tune of nearly 5%. But remember, yesterday was also the weekly options expiry. Perhaps to a certain extent, this had something to do with it, but we saw a 0.4% advance for the Bank Nifty as well yesterday. Now, today is the Nifty weekly options expiry, and while we had mixed cues coming in as far as your overall change in OI is concerned yesterday, moving into today, we're still keeping an eye on our roughly 500 point odds range, while 23,000 put is where we've seen a substantial amount of accumulation, and that potentially could serve as a little bit of a base in today's day of trade. On the higher end, of course, we do have substantial amount of writing around the 23,400 and 23,500 calls, and that would potentially provide you with some amount of resistance on the higher end. Not completely ruling out a very sharp up move, but should we in fact see more strength on the Nifty today, and perhaps if it does sustain about 23,400, 23,500, you never know, we could see a lot of these calls being covered. But let's move on and talk about stocks then. And yesterday, again, it was a mixed day of trade, even though we had more gains than losers, more gainers than losers, pardon me. And of course, we did see longs in Sun TV, Ambuja Cement, Crompton, shorts for Pidilite as well as Interglobe Aviation, and among stocks which saw unwinding, about a short covering for Container Corp, Balrampur Chini, as well as ABP India. And on the other hand, we saw a little bit of longs unwinding for GMR Airport. So these are some of the cues that we're keeping an eye on. But now that we have the big event out of the way last week, now that the dust has settled, we are looking at a lot of these benchmarks consolidating at the moment. The question really is, what do you do with them now going forward? Well, we have Rahul Ghosh of Hedgestock In, who's joining us on the show. Rahul, good morning. Thanks so much for joining in. What's your reading now, and what's the way forward when it comes to the benchmarks?
Good morning, and thank you for having me. So the current reading on the benchmarks is that the upside is very limited. At 23,400 or thereabouts where we are, we don't see more than about 350 points on the upside. But if you take the second half of June and the July series, we expect that markets might consolidate and have a small downtick as well. And when I say small downtick, we don't expect anything major. We don't expect 22,500 to get breached on the downside. But yes, a small downtick or profit booking is generally what is on the cards and is expected.
All right. So based on that, what kind of an option structure are you deploying, Rahul?
So exactly keeping this view in mind, we've come up with an option structure where what we're doing is we are buying the 23,300 put, but of July series, because we want some time in hand, even though there's about 15 days in June. That's not enough. So we need some more time in hand. So 23,300 put option of July, it's fairly liquid. We go ahead and buy that. This gives us room for the trade to play out. The premium with today's gap up should be approximately around 320 odd levels. To offset this premium, we are using the 4th July expiry. So the first is 23,300 of end July. And to offset this, we're selling 23,000 of 4th July and 22,000 PE of 4th July once again. So I'll repeat, 2 puts we are selling for 1 put bought. The 2 sold puts are 23,000 4th July expiry and 22,000 4th July expiry. A combination of these will give you a premium of approximately 180 odd rupees. So the outflow is about 320, 330 and the inflow is about 180. But mind you, because it's the 4th July expiry, we can gain back some more premium by selling the rest of the 3 weeks of July expiries to make the trade as close to break even in case markets do not move on the downside in June and July. So a little patient trade, but very high probability. Why? Because in case markets don't move down, you barely lose any money because you keep buying back the bought premium with the sold puts. And in case market remains sideways or goes down, you tend to profit on the downside.
All right, Rahul, so then let's talk about adjustments now. Firstly, if you could tell us the horizon for this specific option structure. Also moving on, if we do need to roll over the 4th July puts onto the subsequent week, under what circumstances would you do that?
So the only time we would roll over the 4th July puts is if Nifty stays above 23,300, which is our anchor strike. And we've come to the end of June or we've come to the 4th of July. Till then, it's just a patient game. The trade needs to be open till July. It's not a trade for the month of June. So how the adjustment would work is we would buy back the 4th July sold puts, which would essentially expire worthless because markets did not move down. The trade went against our view. And we would sell 11th July expiry. On 11th July, we would buy back the 11th July puts and sell 18th July puts and so on and so forth. Every time we do this, we get back some amount of credit, What that essentially means is our risk keeps coming down with every passing week. So even though the holding period is slightly longer, the risk is very negligible owing to majority of the premium being made back by us by the sold puts.
And if you could tell us about the consideration in terms of risk and reward per lot here?
The risk is fairly low. What we've done is we've kept a stop loss at 22,200. We don't expect the markets to go to 22,200. If you remember, I mentioned 22,500 is where we expect the markets to correct to if there is a correction. At 22,200, you can take a stop loss and exit the entire position. Depending upon the time of the month, we expect the risks to be about 100 to 150 points in Nifty, which would be about 1,500 rupees a lot approximately for I beg your pardon, between 1,500 and 2,500 rupees a lot, which is about 70 to 100 points. And in terms of reward, once again, depends on the time of month you are. If you're very close to 4th July, your reward can be as high as 4,000 to 5,000 rupees, but an average reward to expect should be around rupees 3,000, which is double of our risk, which is acceptable.
All right. All right. So that's as far as benchmarks is concerned. Rahul, any stocks on your radar at the moment?
Yeah. Also wanted to inform viewers that the strategy last week, which was on the bullish side, once again paid off really well once again. On the stocks front, Dixon Technologies is something that we continue to keep our eye on the equity side and on the option side. So Dixon Technologies, what one can do is above 10,400 in spot. It's currently around 10,330 if my memory serves me right. We can buy the 10,500 call of June end expiry and sell the 10,600 call of June end expiry. This would be a simple bull call spread with 10,500 and 10,600, with the caveat that we enter this once prices cross 10,400 on the upside.
Absolutely. Straightforward strategy there. And Dixon Technologies on the radar of several, traders who actually deal in momentum, cross-section momentum specifically. And of course, Dixon Technologies is now starting to pop up in some of those scanners. So we'll continue to keep an eye on that one. But Rahul, on that note, taking a moment to thank you for joining us and taking us through your views on the markets, helping us how to employ and use options in such circumstances, and also giving us that call on Dixon Technologies. With that, it's back to you, Tamanna.
Yep, and Kunal Rambia is joining us now. I'm also joined by Neera Vashar. Kunal Rambia is founder at The Street. Neera Vashar is head of equity research analyst at Latan Manharlal Securities. Welcome to both of you, and thank you so much for speaking with us today. Let me come to you, Kunal, first on what you see as the levels today on the Nifty and the Bank Nifty. We've had a positive close yesterday, but overall I would say a bit of a subdued day of trade. What is your outlook?
Morning, everyone. Thank you so much for having me on the show. So if you look at the overall trend of Nifty since December 2023 so far, it's been overall positive. Every decline is seen as a buying opportunity because consistently Nifty is making higher top, higher bottoms. And what we saw was on the exit poll date when the Nifty made the new high, we are back to the same level within just 2 or 3 days of correction and the reversal. So so far the trend remains very much intact and very much positive. But if you look at the very short-term behavior, it's been 3 days the Nifty is struggling near 23,350 kind of levels. Now what are we supposed to do is just keep an eye on this resistance level, which is at around 23,400. If Nifty manages to close about 23,400, I think 200 to 250 points more on the upside is very likely. On the lower end, 23,200 seems to be the good support. That's 120 points away from the present level. But yeah, broadly, even on the short-term horizon, Nifty is looking more or less positive and the trend remains intact. Buy on dip can be a good strategy.
Okay, buy and dip is the strategy over here. If we see the dip or not, we'll have to wait and see. Kunal, what about your top picks this morning?
So I'm looking at a couple of stocks and those are from the different sectors. The first is NFL. If you look at this counter, it gave a good momentum just a couple of days back. It was up around 12%. Right now, it's trading at around 112. I think with the stop loss of 105, one can think of initiating a buy on this. The stop loss can be 105 because that's because of the volatility. The target can be 130, and advice is to trail the stop loss when the target is achieved. The second is a Hindustan Copper. Again, this counter is broadly recovered from the extreme lows of 4th June, consolidating in the sideways narrow momentum. Yesterday was a good momentum again. with the stop loss of 325, one can think of buying this with the target of 365. That's a positional target again. And the third one is LIC of India. Now, again, this counter recovered sharply, consolidating near 1000 levels. So with the stop loss of 970, one can initiate a buy on this. The target can be 1050. All three counters which we discussed, one can initiate with the positional mindset. If the target is achieved, revisit our channel and keep asking for the new views. I think trailing stop loss will make a lot of sense for all three counters.
Say our channel, Kunal, you mean our channel, right?
Absolutely, absolutely.
Okay, just making sure. No, on a lighter note, I'm going to ask you about all the insurance counters as well, because that's the buzz this morning, Nirav. But let me start with your overview. And do you think the insurance pack will be in focus? How do you see this whole surrender value story? Do you see it as a negative? HDFC Life has come out and said that they're going to have maybe 100 bips impact on margins. The bigger players may benefit. SBI Life seems to be a hot favorite. How do you see the whole development?
Yeah, good morning and thank you for having me on your show. I think as you rightly pointed out, the surrender value, the increase in the surrender value, the revision in the surrender value, definitely it's going to impact the smaller players. But if one were to look at the players with a larger base like LIC of India or SBI Life, ICICI Pru also to a certain extent, I think they may actually end up being beneficiaries to some extent. And as you rightly pointed out, I think HDFC Life, for them, it's going to be a slight dent. But overall, I think they should be able to tide through this development.
Nirav, you can come in on the cement sector. Now, yesterday we had a handful of brokerages which suggested that price hikes for the cement sector are on the anvil, and because of that, there could be a potential inflow, of course, improved cash flows for a lot of cement companies going forward, notwithstanding the seasonal effect that monsoons could play on the cement sector. What's your overall view, and any of those names that stand out for you here?
Well, as far as the cement sector is concerned, we've been hearing stories that there's going to be a price hike. In some cases, price hikes were announced in certain regions. And as you know, that cement is a very region-specific business. And quietly, some price hikes had to be rolled back also because the market did not have the capacity to absorb this. Also, there is a problem of surplus capacity and demand getting muted at some points of time. This quarter, the last quarter has been the pre-election quarter, and now we will be having the monsoon. So construction activities generally tend to be subdued during this point of time. So I think I wouldn't subscribe to this theory that the price hikes might hold on. But looking at the other side, I think we are looking at cost optimization being a strategy which could work for companies. So from that perspective, we are more confident about the prospects of companies like UltraTech Cement and Ambuja Cement in particular. I think we had highlighted this earlier also, that Ambuja Cement is working very hard on the cost optimization side. And I think these are the companies, Dalmia Bharat is there, or Shree Cement is there, UltraTech Cement is there, Ambuja Cement. They're working very hard on the improving their EBITDA margins, improving the share of waste heat recovery system, and trying to control their cost by using synergies, various group synergies as well. So I think these are the companies which should benefit rather than those companies which are expecting a rate increase in the rate.
What's your top pick from the cement pack, Nirav?
I think I'll go with Ambuja Cement.
Okay. Ambuja Cement is your top pick. Kunal, you have a view on the charts for Ambuja?
Absolutely. So if you look at the overall cement pack, I think they are doing pretty good. Especially the Ambuja Cement, if you look at the structure, the counter recently showed a really good momentum. The trend remains positive from December so far. The counter is near to the previous peak, that's of around 3rd June. Again, that's the temporary resistance on the chart. I think once 675 is taken out, the counter is ready for 725, 730. We have to maintain the stop loss at around 750. For the improved volatility and the risk management part, but otherwise I think 725 is likely on the chart.
All right, so that's as far as the cement sector is concerned, but let's talk about FMCG now. And well, from what we understand, the Nestle India will continue paying general license fee or a royalty at the existing rate of 4.5% net of taxes to its Swiss parent. We have our colleague Mahima who's joining us to give us more perspective on this one. Good morning, Mahima.
Good morning, Agam. So as you rightly mentioned that Nestle will continue to pay royalty at the rate of 4.5% to its Swiss parent. Well, in the previous time, it was proposed that the royalty will be raised from 4.5% to 5.25%. However, 57% shareholders voted against this proposal. About 71% of public shareholders holding 37.24% voted against the resolution. Now, basically, promoters hold 62.76%, but promoters are ineligible to vote because of the related party transaction aspect, and hence the entire notion was taken down. Going forward, they've also said that approval of board will be required in order to raise this royalty from 4.5%, and this will be considered every 5 years. Now, just to give a perspective of how other FMCG companies pay royalty, Colgate pays around 4.5%, Procter & Gamble pay around 5%, Hindustan Unilever pays around 3.45%. Now, in terms of Nestle's stock performance, the stock has been up around 4.5% since 4th of June. However, 6 months it's been down around 6.8%, and 1 year it's been up around 13.8%. The stock has been under some kind of pressure since the past 6 months. So today the stock might see some kind of upside because keeping the royalties at 4.5% will keep the margins intact.
All right, so Nestle, I think good news is you don't have to pay more royalty, but is that enough of good news is the question. Nirav, any view on Nestle, which, if you had to go in for a longer term view on this whole consumption play, would Nestle be in your top 3?
Yes, definitely. And I think we've seen till now in the FMCG more talk about the green shoots of recovery as far as the rural economy is concerned. But I think Nestle is more urban centric. So I think from that perspective, the demand tends to be quite strong, and we have the premiumization play which could also come into effect. Apart from this, the stock has been split also, and we have the royalty which has been kept at 4.5%. So I think that would be a big relief as far as the shareholders are concerned. And I think more or less we should see a positive reaction as far as the near term is concerned. But I think I would wait for the quarterly results also to confirm whether there has been a real tangible recovery which is seen in the FMCG space. But overall, I think we continue to like Nestle and HUL in this particular space.
Talking about Nestle and the way things have panned out for this particular company over the last 6 months, and I talk about since the December, it's exactly where it was back in December. Sure, it has gone up and you moved above the mark of 2,700 rupees per share at one point in time earlier in Jan, but there's been largely consolidation, and well, I'm looking at the weekly chart, and there's just been a very, very slight tilt towards the downside in terms of a trend. But I'm going to hand it over to Kunal to ascertain whether or not that is in fact true. So Kunal, what's your assessment on Nestle at the moment?
See, Agam, you made my life a little easy by explaining the entire thing. Yes, from 2750, the counter is down. Jan 2024, it was at 2750. The second high was somewhere near to April, where the counter came down and made a low, the lower high, I would say, at 2725, and right now it's at 2550. So overall trend is, in the recent times, the trend is negative. But if I look at the weekly chart, from longer term perspective, the trend remains absolutely intact. So if someone wants to play the momentum on this counter, I would say wait for the breakout of 2600. If the counter manages to go about 2600, then 2750, 2800 are very likely. If someone wants to play positional bet on this, then I would say wait for consolidation and let's wait for the counter to reach support that's at around 2450 and accumulate near that level. In all senses, the trend is positive. One can definitely accumulate this counter from long-term point of view.
All right, Nestle looks interesting. Kunal, very quickly, anything else in that entire pack that you like? HUL, CP, Dabur, Imami?
Yeah. So I actually shortlisted ITC in the entire pack. The only reason being recently we saw the consolidation again, and the counter is really near to the breakout zone itself. and that's at around 440. If counter manages to go above 440, I think the first target of 465 and above that 495 is very much likely. So yes, I'm very bullish on ITC. I'm just waiting for the breakout of 440.
Okay.
All right. Well, moving on, as far as, well, of course, that's the FMCG pack, but I'm going to perhaps revisit how things are faring as far as the insurance sector is concerned, and want to take a look at, well, SBI Life Insurance and HDFC Life Insurance. Of course, two of your larger insurers. I'm not talking about LIC in this case because that's a giant. But, in terms of how things have panned out over the last few weeks, again, this is where it's turned out to be a frustrating, investment over the last many, 3 to 4 years. We really haven't seen as much traction there, and I reckon a lot of investors are just waiting by for something to happen in this sector. Authorities and rules in general have not been in favor, but the real question is that is there any scope of some sort of a positive traction going in? I'm going to take this up with Kunal. What's your assessment? Let's talk about HDFC Life and SBI Life here. What do you see?
See, Agam, I'm very bullish on HDFC Life. The reason being, if you look at the chart since inception so far, that's from 2018 so far, this counter made 5 bottoms. The first bottom was somewhere in 2018 near 300. Then the second bottom was in 2019 near 325, 345, 380 somewhere in 2020. 490 somewhere in 2023, and recent bottom at 540. If you connect all the bottoms, the trend is absolutely intact and it's just taking the support on the trend line itself. If you look at the daily chart, it made recently 2 equal bottoms near 540. I'm very bullish on this counter. If HDFC Life manages to cross above 580, I think it can be a complete bounce and a turnaround. From the midterm perspective, the targets can be as high as 650. So that's a view on HDFC Life. One can think of accumulating. Just keep the stop loss of 540, and any zone between the present level till 540 can be a good buying opportunity.
All right, so we're talking about insurance, but why are we talking about insurance? Puneet is joining us for more on this. We'll also be speaking to Harsh in just a second, who's live from the Morgan Stanley conference this morning, so we'll get a take there as well. But Puneet, for now, what we understand is that IRDAI has issued rules for surrender value. That story on our website as well, where they have asked to facilitate loans against their policy too. But for now, we'll talk about the increase in surrender value that IRDAI, the regulator, has mandated. What does it mean for life insurance companies? How will it impact?
Well, that's right. So these rules have been going on for some time now. There has been a lot of deliberation on it. And essentially, what surrender value is that, it's the amount payable to a person who will give back the insurance policy to the insurer. And that amount has been very low comparatively. That's what the regulator has been saying. So IRDAI has been proposing better surrender value terms. And now finally those regulations have come in. So let me just go on to the brokerages of what they are saying. So Nuvama has said that, special surrender values are expected to rise from this particular level. The regulations have been changed to avoid any kind of mis-selling and protect insurer policy interest for the policy holders as well. They've also said that the surrender values will indirectly increase any kind of commission that insurance would have generally paid. So they are seeing some commission stress on commissions going forward. And lower commission payout shall aid larger firms such as HDFC Life and SBI, which we were talking about. There could be some impact on growth. That's what Nuvama thinks. This will be a little difficult to assess at this point of time since the regulations have just come in. So a lot more details on disclosures and other factors seem to be looked at. And for Nuvama, they see HDFC Life and LIC as well as the other players to benefit, but there will be some more traction that will be needed. And finally, just on MK, they have said what are the key changes here. Basically, these include that surrender value will now be given after the first premium payment, which was a key contention that these insurers had. They have also said that any kind of discount rate will be decided now on 10-year GSEC, which I think Harish can talk about a bit more, plus 50 basis points, and this is a key positive for the insurer. So MK likes HDFC Life, ICICI Pro as well as SBI Life here. they see roughly 20 to 27% on positive upside from here.
Right. Thank you for that, Puneet. And you're right, we'll get more perspective on that from Harsh, who's joining us live from the Morgan Stanley India Investor Forum. So an interesting morning there, Harsh, and of course we'll be looking forward to all your conversations there as well. But I know that you look at this sector very closely. And what really is going to be the changes that large life insurance companies will have to make?
Well, the biggest shift is going to be in terms of the fact that the minute you're taking an insurance, the first year after you take the insurance, you're not allowed to exit it. And if you do exit it, you get no surrender value as a consumer. That changes in a big way currently. So basis the current or the existing regulations as of yesterday, that was not permitted, or what terms most life insurers were giving was there will be no surrender value given to the consumer or the policy holder. That changes in a big way, because what the current regulation now says is the present value of everything that a consumer or a policy holder has paid, in discounted of course, so in present value terms, needs to be returned back to the policy holder in a fair and transparent manner. Therefore, what they are seeming to suggest is that earlier, where life insurers would not be paying anything when an insurer or policyholder exits his policy, now there is a regulation of a minimum threshold of payment that a life insurer must do. And that is a big positive, according to me, for the consumer and the policyholder. The other aim of the insurance regulator is to try and streamline and avoid or limit the mis-selling of life insurance products. This will likely lead to that as well, because you have upfront commissions which are paid out, which are fairly large, and therefore the fact that the policy might get surrendered will avoid any mis-selling. So the life insurers will want to underwrite longer term policies, because that will benefit them more. And in case a policyholder cancels his policy, it will in fact be a burden on the life insurers. The impact with regard to margins here will be key, because upfront commissions are large, and therefore any kind of mis-selling or any kind of withdrawal from the policyholder will lead to a slightly chunky loss coming through for life insurers, and therefore impact profitability and margins. Of course, it's extremely interesting, but it's also very difficult to assess which insurers will be most impacted. So that's still a limbo, but we'll obviously have to analyze that more. Of course, Nuvama, Citi and MK coming out with their views and expressing the difficulty in ascertaining which ones will get impacted the most. But HDFC Life and LIC, basis FY24 numbers, seem to have been impacted. But also HDFC Life has a long history of being able to adapt very well in terms of changing its terms for products. So will be an interesting space to watch out, especially commentary coming from insurers.
Right. Harsha, well, thanks so much for all those insights and updates. But just hang on. Well, you are at the Morgan Stanley conference for this year. What are the key takeaways that you're going to keep an eye on? What are you going to look forward to? And also, if you could tell us about the conversation that you're having.
Well, Agam, it's an extremely interesting inflection point, because you're already seeing the CPI inflation come lower. You're also having conversations around the rainfall this year, because that will essentially impact agri, and also the election results. So there have been 2 to 3 big macro factors which are obviously going to play out in all the conversations that we are having here. The other piece, of course, which I'm going to more specifically focus on, is with regard to banking and financial services. Where do banks go from here? Of course, rate cuts likely on the anvil, some projecting 1 rate cut, some 2, but nonetheless the rate cuts are on the anvil, and therefore which are those banks which will disproportionately benefit from these rate cuts is something that I will be really keen to understand, and of course we'll have that conversation in just a few moments.
All right, so we look forward to all of those details. Thank you for that, Harsh Saita, there this morning at the Morgan Stanley Investor Conference, and we'll get all those updates and conversations from him. Meanwhile, pre-open rates kind of settled. Let's get the first take in from Kunal and Nirav. Sun Pharma up 10% now. So a lot of moves over there this morning. HDFC Life was doing fairly well. Nestle showing a positive kind of a move. So now HDFC Life down in the red. So we'll have to wait for those rates to settle. Nestle I see as positive. Maybe some relief there coming in on the fact that they don't have to improve their or increase their royalty rates. M&M, some of these counters. I just want to see what's happening with Interglobe and L&T Finance. Both are block deal candidates today, and we'll be seeing some stakes being paired. Interglobe already saw from its one of its promoters, but does that continue? Nothing ticking on L&T Finance yet, but that's one to keep an eye out for. Kunal, anything that you're spotting or you want to add on to your first hit of morning trades after seeing the pre-open action?
See, I think FDC is looking attractive as of now. If you look at FDC price, it's showing that it's almost up by 0.5%. If you look at the recent behavior, the counter recovered from 420 levels to almost 460, and it's in the positive trend itself. So considering that, I think with the stop loss of 445, one can think of initiating a buy on FDC after the recent numbers which were published. I think the company is doing good on the pharmaceutical front also. With the target of 485, one can think of buying FDC. The stop loss can be 450 for now.
I was just looking at 361 WAM, one of the stocks that we picked this morning, and that's also not seeing a bad pre-open trend at all, about 3.5%, nearly 4% up on the acquisition of ET Money. So those are some of the stocks. Let's look at Sobha. You were talking about it, Agam. Let's see how Sobha is doing this morning as well. That's about 2% up, but nothing massive changing, perhaps, as far as the first rates go. HDFC Life now in the red. I want to take a look at some of those other insurance plays. Are we seeing anything clear on SBI Life yet? What's happening with LIC? Some of those to watch this morning. Kunal, any of these that you are tracking or that you like at these levels?
See, let's just wait for a couple of minutes to settle down in terms of price. As I discussed, I think I'm very comfortable so far with LIC and HDFC Life. We'll see how it opens. I think we'll be able to share the levels better with our viewers. Just a couple of minutes.
Well, I actually want to take up the real estate sector with Nirav, if we could, because we're still seeing, a lot of these companies still trade at life highs. And I'm not saying that I'm surprised, but now there are some questions being raised with respect to their valuations. Sure enough, there is a lot of visibility with the kind of projects that are already lined up for a lot of these companies, and especially when inventory levels are reducing, month on month. But Nirav, going ahead, do you think that some caution is now warranted when it comes to the real estate sector, or do you still think that things are not as bad?
Well, I think things are not that bad, and I think the demand continues to be quite robust, and we've seen the aspirational value of real estate and how things have changed after COVID. So I think continue to remain positive on the real estate story. And on their side, on the company side, they have also undertaken a lot of efforts like deleveraging exercises, improving their cash flows, getting the projects to be executed in a timely fashion, etc. So I think that the dynamics of the sector have changed drastically, and I think this trend is likely to sustain in the near future.
All right, that's the story with Godrej Properties, one of the real estate plays that is working. Meanwhile, if you look at what's happening in the pre-open rates, which have settled now, you are perhaps looking at another day of muted kind of trade, at least in the first few minutes. We'll wait and see. Not too much of action, but definitely in positive territory. On the frontline stocks, Nestle about 2.5% up, the biggest biggest gainer after the pre-open rates have settled. Ultratech, M&M, all of these are going to be in focus through the day. Dr. Reddy's as well. Dr. Reddy's, we told you one of its arms have had a tie-up for a new injection of cancer for treating various kinds of cancer in the US. So that's doing okay. Nirav, would you look at the pharma space right now? Divi's, Dr. Reddy's, all of them in focus this morning?
Yeah, they're looking attractive, but I think my focus is on Biocon at the moment. I think the stock has given a very good up move and it's given a good guidance going forward. So I'd be more stock specific in the pharma space with a focus on Biocon especially.
All right. Well, now that we have the pre-open, which has been settled, it's very close to the 23,500 mark, and perhaps Kunal can confirm this for me. Kunal, we are looking at a lot of call accumulation around 23,500, and that particular strike. Should we see some strength in open? What's your assessment? How would you go about, your intraday trading, considering today is also the Nifty weekly options expiry?
So, Agam, this weekly expiry is turning out to be like a problem for the trend followers, especially now because we have seen a lot of open interest near 23,500 mark and Nifty is opening right near that level. If after 15 minutes, so it's a very simple strategy which I advise to everyone, that after 15 minutes, if the high is taken out, then just wait for the consolidation and stay with the bullish momentum. But if the low is taken out, I'll be the first one to short. So 23,500 itself is the strong resistance. If the Nifty manages to stay above that for at least 15 to 20 minutes, I'll stay long. Otherwise, this will be the high where I'll start shorting at least for intraday, and the targets can be 23,350.
All right. So that's the strategy on at least the index as we see. But let's talk about L&T Finance for a second. Kunal, is this something you're tracking? The block deal news, of course, today. Stock has done fairly decently in the pre-open session as well, about 2.5% up. Would you initiate a trade at these levels?
Absolutely, Tamanna. We shortlisted this counter. If you look at the historical data from Jan 2024 so far, counter has tested 175 mark almost 7 times. This is the 7th time when the counter is again reaching back to 175. Managed to close above 175. I think we can see the targets of 195 to 200 levels. So I'm very bullish. I'm just waiting for a closing above 175. And today's trade, it's opening up by 2.5%. So if it manages to stay above that level for even if 15 minutes with the day's low as a stop loss, one can definitely buy, and the targets can be 200.
Okay, target of 200 on L&T Finance is what Kunal likes right now. I'm looking at an LIC. Any interest in an LIC, Nirav, at all? While we're talking about the whole surrender value impact, how does an LIC play out for you? It is still the largest in the space in terms of market share, by a stretch actually.
Yeah, I think we remain positive on LIC because of the base effect, the scale of operations, and its ability to adapt to the changing market conditions. So I think remain positive.
Nirav, a quick question on how defense is panning out right now. Names like Bharat Electronics and something like a Hindustan Aeronautics, even from the shipping space, something like a Mazagon Dock, after the 4th of June, which actually did see a very sharp cut there, we're now starting to see a little bit of recovery here on. What's the way forward here?
Actually, I think the indigenization of defense is a theme which is inevitable, and there's a lot of thrust by the government on this particular aspect. And if you look at the order books of all these companies, they're absolutely full. If you look at the shipbuilding companies, I think the government is very, very serious that they want to take the indigenization element in the shipbuilding to approximately 75%. So it's already touched that 75% at this point of time. Plus the order books of all these companies are absolutely full. The margins have been improving. And if you just see the latest quarterly results, the execution has been very, very strong and the visibility remains very, very strong. So I think there are no two ways about it. We are definitely going to see uptick in all these shipbuilding stocks. As far as HAL is concerned, they have also gone on to say that their order book is close to 95,000 crores at this point of time. So just look at the revenue visibility over a period of time. Execution is going to pick up. They've clearly said that they want to scale up the production of the light combat aircraft in this particular year. As far as Bharat Electronics is concerned, they have an order book of close to 75,000 crores. In FY25, they are looking at order inflows of 10,000 crores, plus the missile programs which are slated. And even they've got visibility as far as FY26 is concerned. So there is a huge amount of order books which these companies are staring at, and I think margins should not be a problem. Execution should not be a problem. There's a complete boost as far as defense is concerned. So I think these stocks should continue to do well.
Kunal, a 15-second answer on your top pick this morning before we hit the first rates.
The first is India Bulls Housing. I think this counter has given yesterday's breakout. Today also it's opening near to the high itself. So with the stop loss of 165, one can initiate a buy with the target of 200 as a positional target.
Okay, so that was even more efficient, not even 15 seconds, but India Bulls Housing is a top pick of Kunal. Now, just 20 seconds before we count down. Remember, it has been a calm after the storm. That's how I describe most of the trading week. We're already on Thursday, but the big trigger this morning is definitely still going to be what the Federal Reserve's outlook has been. It's been less hawkish than expected. Will we see that move in IT stocks over the day? Overall, Asia has also been positive. All right, first hit rates hitting here for the markets and definitely up in the green, 23,400 and above, fairly comfortably. Are we going to see 23,500 levels? We'll wait and see. Bank Nifty not looking bad at all, above 50,000 and comfortable over there as well. The mid cap and small cap actually showing more signs of life, about 3/4% for the small cap, for the mid cap and the small cap, both indices up. Let's pull up the heat map and see what's buzzing this morning in trade and where really the action is. We talked about Nestle in our trade setup, and that really is top of the pack, at least on the front line of the Nifty 50, about 3% up. The reason is that their royalty rate that they're going to transfer has stayed unchanged. That means no additional hit on margins for Nestle. That's good enough. But the fact that it's the top pick also shows that the market is being a little careful today, playing it a little defensive in that sense. LTI, Mindtree, Ultratech, all of them doing okay. We talked about IT being the flavor of the morning, and that seems to have worked out exactly as we said it. LTI Mindtree is up there. So is HCL Tech, Wipro about 1% up. So, you know, that definitely is working out. We talked about Dr. Reddy's also. Dr. Reddy's having a good morning. And remember, they have their arm has tied up for a new drug in the US market. It's an oncology product. HDFC Life in focus. Remember, as the dust settles on the entire surrender value game, HDFC Life is one of the top picks. They also came out early enough to say that they welcome the new surrender policy and will just have a very marginal hit on their profitability. So HDFC Life now quickly moving towards the top position, but still about 1.5%. Not too much red at all, Agam, this morning. Just 4 counters there. That to an HUL, Britannia, Tata Consumer. So it's a consumption space. So Nestle is up there for a very different reason, but the rest is really in the consumption space. Apart from that, you're not seeing a bad morning at all, and IT in flavor.
Absolutely, absolutely. Well, see, you know, we were actually taking stock of how things are panning as far as the broader markets are concerned too. Something like a mid-cap index or a small-cap index, you know, it should be interesting to see how things are faring there. So while we are looking at a 0.1% advance for the mid-cap and the small-cap indices, let's take a look at what's really happening as far as broader markets go. And among stocks which are in focus on the back of news, there are a handful of them. So we start by taking a look at 360 WAM, and that's where we've had some cues coming in. We're in fact looking at about a good 2.3% up move there. Soba's up as much as 4%. Of course, we have more details with respect to the rights issue coming in. And well, it does seem like a lot of traders are at the moment, and investors for that matter, everyone who'd potentially be interested in the rights issue, buying into it. And L&T Finance, of course, on the back of the block deal, we're looking at the 3% uptick there as well. A couple of counters on the back of order wins. So we have something like a Gensol Engineering, which is also well advancing by as much as 5%. In fact, it's locked in an upper circuit of 5%, as is the case for well, Bondada Engineering. So these are two relatively larger orders for both these companies of the relative size, and that's the reason why it does seem like we're seeing a upper circuit for both these respective companies. And taking cues from yesterday, we have two other counters which were buzzing in trade yesterday. Let's see if we have a follow-through buying coming through. It does seem like Gravita India is looking at a bout of profit taking, at least in earlier in the session, as is the case for Elecon Engineering, which is down 2.5%. Remember, both these counters were up anywhere between 6 to 10% yesterday. It does seem like it's taking a breather in today's day of trade. But on the whole, if you consider your broader markets, Tamanna, both the mid-cap and the small-cap indices will continue to outperform the benchmarks like the Nifty and the Bank Nifty.
Absolutely. A lot of specific news-driven flow this morning, I would reckon, Agam. So, Sobha, you talked about, but look at macro tech as well. About 4.5% up. Sugar stocks have been in focus. Sri Renuka, about 5% up. And we're going to be speaking to the management ahead on the show as well. So stay tuned for that. Quick programming reminder. L&T Finance, I wanted to look at. So L&T Finance is seeing a block buying today. And that stock is doing fairly well. That was on Kunal Rambia's radar as well. Paytm I want to pull up. So this has had some interesting news. They've tied up with Samsung, and the Paytm services are going to be available on the Samsung wallet. So enough to show some enthusiasm in that stock this morning. Now on the sell side and on counters which are not working too well, if you pull up that entire list, you will see the entire FMCG pack. That's definitely the theme and the mood this morning's Marico, Dabur, Godrej Consumer, HUL, Colgate, Britannia, all of them in the top loser category on the BSE 500 at least. Sanofi, of course, on top of that pack though. PVR, Inox. So one reckons that the whole consumption theme has eased off. A bit of profit booking there, maybe on a set of stocks which had done fairly okay. Remember, our expert stock pick over there was, in fact, ITC. But the others are not doing too well at all this morning, and that's the big theme. Kunal, let me come to you on what you've spotted after the first rates have hit.
I think market is doing fairly well, and most of the counters are doing good. I think PSU banking sector is looking attractive as of now. If you look at IOB, it's trading at around 68.70 and it has given a gap up open, and I think it's trying to come out of the consolidation. So by any chance, if the counter manages to sustain at the present level with the stop loss of 67, one can initiate a buy, and the first target can be 75, which we saw as a high somewhere in the mid of May. I think that counter is looking fairly good as of now. And the second is Kokoyu Kemlin. You can check that counter that's trading at around 150, 1.5. It's been 4 to 5 days consistently. This counter is outperforming from the extreme low levels. It has come up really well. So with the stop loss of 145, one can think of initiating a buy on that also. And the targets can be 165 again.
All right, so those are two interesting picks. I just want to take a look at what some of the railway stocks are doing this morning. Jupiter Wagons again about 3.5%, 4% up. Let's pull up Titagarh, Ircon, that entire pack and see if that's a broad-based kind of a trend. Yes, it seems to be, so that continues as well. Ircon fairly flat, but those are Railtel, etc. Those are some which seem to be in focus this morning as well. Nirav, your first thoughts after the rates have hit, and anything that you would pick as a theme for the day?
I'd like to look at the sugar space. And I think with the revival of the monsoons, and I think expecting a good monsoons this time around, I think should boost the prospects of the sugar sector. So most of the sugar sector stocks have been beaten down. So it's a good time to have a look at them. Stocks like Balrampur Chini or Bajaj Hindustan, Dhambo Sugar, etc. can be had. Definitely we can have a look at them. And I think IT continues to do well, and selectively would like to look at stocks like HCL Technologies, Tech Mahindra, which look attractive.
Nirav, what we're observing is also recovery in some of your capital good companies like Siemens, Thermax, as well as ABB India. They've all had very, very strong quarters. In fact, before that sharp knock on the 4th of June, we also saw a sharp correction. But since then, we've seen recovery in all these counters. Anything that stands out for you among these?
Yeah, I think we had broadly identified two themes and two sets of themes. In the first theme, we had ABB, Siemens, and Thermax. I think all these look quite attractive. There are different plays out there. One is the electrification, robotics, process automation, etc. Signaling, telecom, waste heat recovery, etc. So all these things have played out over there. And the second set is having a look at CG Power and Industrial Systems, Exide Industries, and Amar Raja Energy and Mobility. So I think we like all these 6 stocks, and we are very hopeful that all these stocks will perform quite well in the times to come.
All right, Amar Raja also on the radar. All right, let's quickly go across to Harsh Saita, my colleague, who's in conversation with Sumit Kariwala, India Bank's analyst at Morgan Stanley.
Look at the valuation gap between private and state-owned banks. They've narrowed to historical lows. I'm not saying that state-owned banks are going to surprise negatively on earnings.
Sure.
They will do well. They have improved their loan mix towards retail SME. They've improved some bit of underwriting practices. Some of the state banks are doing very well on technology. So it's not that, come 1 or 2 years, they'll have a massive drop in ROA or so on. They'll continue to deliver earnings, and they can also surprise. There's no doubt, because the cycle is so good. But what will happen is that there will be some pockets where private banks can now outperform on earnings quality, and that is where they can re-rate and get their premiums back.
Understood. Okay.
It's a relative call. State-owned banks will do well, but private can do slightly better, especially given where the valuations are.
Understood. So we are nowhere close to mid-cycle is my understanding of what you're saying. So we still have a very long cycle to go. That's essentially the underlying.
When you talk about asset quality, the only, as compared to previous cycle, the only headwind that I see in this cycle, which is very unique. Historically, bank margins were not linked to policy rates. So we never used to be in a situation where we used to worry about, say, PPOP or margin or fees. And, it was very easy to call banking cycles, just focus on asset quality. When asset quality problems come back, you just sell off the lower quality banks and so on. This is slightly unique and differentiated because now 40 to 60% of the bank's loan book are linked to policy rates.
Yes.
And what is the other thing which I'm seeing is that there is very high competitive intensity in certain lending segments, especially by certain players. And a combination of these two factors will mean that even though the asset quality cycle is good, there could be margin pressure and therefore PPOP pressure at select banks, which could come sooner than expected. That is the differentiating characteristics of this cycle, and that is something which is very important. And this is, again, I'm trying to build on the story that we are talking about, that in some of these headwinds, be it margin, competitive intensity, the private banks can actually do a better job. And that's where this scarcity premium kind of comes back. So when you talk about asset quality, I think so we are in very early stages. When you think about margin pressures, I think so we are somewhere in the mid-cycle. Loan growth, again, very early stages.
Understood. So that's an excellent start. What I want to try and get to now is, and you put it very beautifully, the fact that private sector banks are much better placed for the rate cut cycle, which is coming up, than PSU or SOE banks. And within private, I also want to understand your views, whether small, mid private is better, or whether the larger ones is what will outperform in this at least margin re-rating cycle. So talk us through some of the factors which one should look out for going into this possible reduction in repo.
Yeah. So let's divide banks into two parts, large banks and small banks.
Sure.
When I look at large banks, and most of the large banks have 40 to 60% of the loan book linked to repo. So whenever RBI cuts rates, right now we're not assuming any rate cut over the next 1.5 years, but whenever RBI cuts rates, there'll be an immediate impact on all the banks. Okay, but banks, when you look at from a 1 year perspective, banks will be able to recoup a lot of that because the deposits will also reprice lower. But the point is that which banks will be able to manage that transition better. So if you look at private, they've been aggressively shifting their loan mix towards high margin assets. They've been very selective on what kind of assets they are cherry picking. Okay, and to that extent, what I see is that when I look at the starting point of margins compared to historical cycle averages, a lot of private banks have a lot of buffer. So there are banks where margins are 30 to 50 bips higher than the historical averages.
Sure.
This is not something which I see with the state-owned banks. And what will happen is that as you see a potential rate cut cycle, as you see competitive intensity kind of sustain, as you see deposit costs continue to move up, some of these banks will be able to retain their margins still above pre-cycle averages. And that would mean that the ROA, while it's moderating, it's still above cycle averages, and that's a good point. And when they're able to do that, people will say, okay, the ROA moderation for these banks is lower, these banks is higher. And to that extent, again, getting back to the point, that's where you see that some of that scarcity premium build up and reallocation from low quality banks to high quality banks. And
all right, you can see that entire conversation ahead of the day on NDTV Profit and, of course, on all our social media sites. So watch out for that. But meanwhile, we'll take a very short break. On the other side, we're talking to India Pesticides on their new plant. They've commissioned an intermediate plant. What is that all about? What's their plan ahead? That conversation after the break.
The war is completely shifted towards drone-based attacks. Even Elon Musk said the warfare is going to be drones versus drones, not human beings versus human beings. So I think the counter-drone systems and the whole of drone ecosystem is going to get a very big boost in the next 5 years. And the second is the amount of combat readiness. You may be having Iron Dome and all that, but people are coming in with hand gliders and taking over the country. That means something, the preparedness, lack of preparedness, something. Even when we look at Ukraine, it has world's most advanced equipment gifted, but it's not able to operate it. And with vintage equipment, Russia is able to really, really inflict tremendous damage on Ukraine. So training is going to become the second most important thing after the drone ecosystem development.
Look, while you are trying to get
Welcome back, where we are taking stock of India Pesticides now. Well, we have an update with respect to the monsoons very recently, and we thought it would be a good conversation to have with how the sector is expected to come through based on what we can expect. And going forward, what are the cues to keep an eye on as far as the pesticides industry is concerned. So let's get in the management of India Pesticides. We have DK Jain, Chief Executive Officer at India Pesticides, with us. Mr. Jain, good morning. Thank you so much for joining in. A view on potential in demand going forward. We've been looking at the year gone by. It's not been the most encouraging, at least as far as Q4 is concerned. But do you think that we can start seeing positive traction going in?
Yes, sir. Last year, it has been a very challenging year for all the agrochemical industry. But this year, now the things are getting better. And we feel that in 1 or 2 quarters, it should improve a lot. Last year, it has been really a very challenging year in terms of geopolitical situations, overstocking by the MNCs, and slightly better bad weather conditions in many parts of the world and also in India. But now the authorities have predicted normal monsoon, so we feel that Indian demand will be reasonably good and it will grow. And similarly, the geopolitical situations are getting slightly better, and we are getting better orders now for exports also.
Mr. Jain, just, you talked about how it has been a challenging year, and that's clearly showing in your numbers. Your EBITDA margins, I would say, crashed in a sense from 21% to 3% year on year. Net profit was also hit. Let me just talk about where you see margins improving to. You're saying demand will come in because monsoons are seeming fine in India, maybe more focus on rural India from the new government, etc. Where do you see EBITDA margins going back to?
Yeah, EBITDA margins, madam, it is really difficult to tell exactly where we are going ahead, but it will be better than what we are having present. We expect at least 17 to 20% of EBITDA margin in the coming quarters.
Okay, so you're going to jump from 3% back to 17 to 20%. And where will that boost come from? Because your volumes, which you were expecting to improve in Q4, also did not quite improve. So what is the reason that you're expecting those volumes to come back as well?
Volumes, we are getting good export orders now. Last year, two of our major volume products, the demand was very less. But this year we are getting good demand and we have got good orders on hand for these products. And apart from this, we have slightly changed our product mix. And in this, we are getting good domestic demand for some of our products. So the volume would come from domestic as well as from exports.
The mix you're expecting split between domestic and exports in your volume mix for Q1 and for the next financial year?
Yeah, it will be, madam, about 50% export and 50% domestic market. It has been like that only last year. It has slightly changed the revenue because the export market was down very much. But this year again, it is going to pick up and we would be reaching around 50%.
Right. Mr. Jain, can you tell us a little bit more about your current installed capacity, the utilization levels? So from our understanding is that you budgeted a capital expenditure of about 110 crores in FY25. Can you tell us how this actually pans out for your overall capacity as well?
Yeah, our capacity, total production capacity is 24,200 metric tons per year. And our capacity utilization this year has been low, about 50%. But the coming year, it will increase to about 70 to 75%. And we have also adding new products. So that will augment the capacity by realigning our plant capacities for better product mix.
So where does this 110 crores of capital expenditure go towards? What areas?
Sir, in this, we are adding one intermediate complex in our existing plant at Sandila, and 60 crores we are spending in our subsidiary, 100% subsidiary by name Shalvi Specialties, which is coming up at Hamirpur. So we would be doing a capex this year of 60 crores, and we have planned a capex of about 400 crores in the coming 3 to 4 years at Sandila, at Hamirpur site.
And so you've also commissioned an intermediate plant towards backward integration. Now, this backward integration is towards fungicides primarily, am I correct? So what are your plans in this particular area?
Yeah, no, it has been our endeavor to reduce our dependency on Chinese imports. So we normally do all backward integration of our products, and it is a step in that direction. Last year also we did for one of the major products, for a major herbicide, we did the backward integration and we started producing the intermediate in India. And this year we have added one more molecule in that direction for fungicide. And this intermediate normally has been imported in India. So we have started making this intermediate now in our plant.
All right.
This will reduce dependency on China.
Right. So, and final question from my end, sir, can you give us an outlook based on your revenues for the FY25 going in? This is, of course, assuming that the monsoons are normal or slightly above normal, then demand picks up. What's the way forward as far as your revenues are concerned and your operating margins?
Revenues, sir, we are expecting revenues of increase of about 20-25% this year, and we expect to have the similar range in the coming years also. And profit, of course, as I told, is difficult to tell exactly as on today, but we feel that 17 to 20% EBITDA margins we should be able to achieve comfortably.
Okay, all right, Mr. Jain, we leave it at that. Thank you so much for joining us and talking to us here on NDTV Profit.
Thank you.
That's the management of India Pesticides telling us about all that is on the anvil for the upcoming financial year. Well, time for a short break, and on the other side, we have an exclusive interview lined up for you with Ivana Bartoletti of Wipro, and we will also be speaking to Sri Renuka Sugars. Stay tuned in. Back in just a bit.
Artificial intelligence does not exist in isolation, right? So already existing legislation do apply to artificial intelligence. So for example, privacy law, privacy and data protection, they already apply to AI. So AI is not neutral in that sense. So it's really important to understand the legislation such as privacy, data protection, the cybersecurity requirements, as well as legislation like human rights and non-discrimination. All of these apply to artificial intelligence. And this is important because a lot of people are here, they keep invoking for new AI regulation. Now, why is this really important to regulate the behavior of people around and businesses around artificial intelligence? It's also very important to recognize that AI already exists.
All right, sugar stocks have been in focus for the last couple of days, ever since Union Minister Hardeep Puri reiterated that we will be achieving the target of 20% ethanol blending by 2025. Remember, this target is something that the government has been talking about for a while, but we are nearly at 2025, and the reiteration has definitely helped the entire pack. Sri Renuka is up 3.5%, but I would reckon that the entire sugar pack is also having another pretty good day. Now, giving us a sector overview today is Atul Chaturvedi, the Executive Chairman at Sri Renuka Sugars. I'm told, Mr. Chaturvedi, that you don't want to talk much about your company, but rather what this policy move will entail. So we'll try and stick to that. But thank you for speaking with us. So let's begin with that key point that the minister said, that Mr. Hardeep Puri said, that we will be sticking to the 20% target of ethanol blending by 2025. So let me begin by asking you whether you think it's achievable.
So first and foremost, I'd like to congratulate the government and the minister for reiterating something we thought was now on the back burner as far as the government is concerned. Because in December of last year, with elections looming ahead, they had banned the ethanol from cane juice as well as B-heavy. But the minister's reiteration that they are on target gives us confidence. It's like a whiff of fresh air. So whatever headwinds the industry was facing by way of ethanol not getting made from cane juice and B-heavy, now I think possibly that will be a thing of the past. So we welcome this decision. But as far as whether we will be achieving this during the current year or next year, that's $1 million question. What we are seeing as of this year, the government requires something like 825 crore liters of ethanol for achieving 15% blending. Against that, till May of 31st, the figures we have, about 327 crore liters has been supplied, of which about 165 crore liters has come from the sugar sector and another 162 crore liters from the grain sector. So this year, their achievement till now is closer to about 12.5%, but I see no reason why they should not be able to achieve 15% in the balanced period of the year. Next year, if we do not have policy flip-flops like we had this year, then I'm sure we are on track to achieve 20% blending as per the Prime Minister's wish of achieving 20% by 2025.
Sure. Mr. Chaturvedi, if you could come in on the sugar production for the sugar year in the upcoming year. And what we have in terms of estimates is a potential decline in production. And that's the anticipation. Based on that, your view on how sugar prices could move, to what extent can we expect hikes considering the demand and supply situation? And secondly, what could that mean when for exports of sugar from India?
So first thing first, I'm not a brave man to start predicting next year's crop. In fact, we tried being brave last year and look what happened. The government panicked and they ended up banning exports. They ended up banning cane juice from into ethanol and B-heavy into ethanol, just to ensure that the sugar prices remain in check. This year, we would much rather not speculate or rather punt on what the crop's going to be. But having said that, let me just share with you that the monsoon this year has been absolutely on track. And we had very good pre-monsoon showers, maybe a little bit of a loss in acreage may have been experienced in Maharashtra, but that I'm sure is going to get compensated by higher yields and higher recoveries. So overall, I don't see the sugar crop numbers coming down next year, contrary to what some of the punters may actually be saying. And international punters are also probably saying something on those lines. So I won't bet on that. Now, whether the exports will happen or not happen, that's $1 million question. As of today, according to the numbers we've penciled in, India would end up having something like 8.6 million tons of sugar at the end of this sugar season, which is about something like 3 million tons higher than the opening stock. So it doesn't make much sense to keep carrying sugar and build on inventory and increase your interest cost. So we would expect the government should at least release 1 million or 1.5 million for exports. So that should reduce the inventory levels. And we don't need to worry too much about the sugar prices because our industry is highly regulated. So I don't see any reason. But if push comes to shove, our first thrust should be on increasing ethanol and then on sugar exports. As it is, the sugar export values have come down and it is not as lucrative as it was about 3 to 4 months back. Yep.
Right. So a twofold question here, sir. Firstly, do you have any expectations when it comes to restrictions on juice and B-heavy molasses for the next season? Do you think that there could be a relaxation here? And also, sir, a word on your expectations when it comes to FRP going ahead.
Reason why this ban on cane juice and B-heavy should not go away. There is absolutely no reason because we do not see sugar stocks inventories coming down and having an impact on the prices. And let me just reiterate that sugar in our country is absolutely inflation proof. If you really look at it, sugar and edible oils in our country have probably seen negative inflation. The inflation as far as our country is concerned is largely pulses and vegetables. So that is what is actually driving inflation, not sugar, not edible oils. So we would feel that the government also is aware of all these numbers because these are all government numbers. So there's no reason why this ban should not get lifted. And secondly, as far as next year FRP is concerned, that has already been announced. But having said this, it's also important that the government actually raises the price at which ethanol is sourced by the oil marketing companies. In fact, it's an anomalous situation where ethanol made from maize is currently being sourced at closer to about 72 rupees a liter, and ethanol from B-heavy at 60, and from cane juice at 65. So I think the government needs to seriously look at jacking up the ethanol prices and bringing it at par with maize. And as far as this MSP is concerned, I think it's high time that MSP got raised, because the last 5 years, FRPs or the cane prices have been jacked up, and next year again is going to be jacked up. And there's been no increase in the minimum selling price. So I think it's important from the industry's perspective that this is institutionalized. So if FRP goes up, the issue price should also go up.
Okay, whether you can bring up prices then or not remains to be seen, since that's, we'll get to that bridge when we cross it, since you're expecting that to happen around Diwali or so. But thank you, Mr. Chaturvedi, for speaking with us today. That was the management of Sri Renuka Sugar, giving us an industry view, actually, more than anything else. Now, before we end the show today, I just wanted to play out a bit of a very interesting conversation I had the opportunity to have. We know that artificial intelligence is the buzzword. Everyone's talking about it, but Agam, the reason that I was keen on this conversation with Ivana Bartoletti, she's a global renowned expert on policy of AI, is now with Wipro as their chief policy head for artificial intelligence, and all IT companies are making big moves there. I talked to her about what the key challenges were, because things like data privacy, how you use AI, and the business case still have to be worked out. So before we get into that break, let me just play a slice of that conversation for you.
At the moment, people will think AI is going to destroy humanity, and people will think that artificial intelligence is going to make us so much better. So responsible AI, to me, means that we are going to define the relationship between humanity and artificial intelligence, and ensure that AI is going to benefit the world by harnessing artificial intelligence as much as we can. But to do so, we have to do it in a way that enhances the values that bring us people together, that enhances dignity, that enhances the way that we deal with the issues of tomorrow, that protects the environment. So to me, responsible AI really means that we, yes, harness the value of AI, but we do it in a way that really protects the world and really builds on the values that bring us together.
Now, having said that, what about this in the Indian context? You're currently, framing that policy for Wipro, a company that is moving very, very quickly on upgrading its AI presence and exposure, as is the entire suite of companies here in India. I mean, India is really trying to rev up and sort of level up on the AI game. So in the Indian context, how do you see it? Because we're still in the process of finding a framework that works for us. Is this going to be something that a country determines, or is this going to have to be a global effort?
So artificial intelligence does not exist in isolation, right? So already existing legislation do apply to artificial intelligence. So for example, privacy law, privacy and data protection, they already apply to AI. So AI is not neutral in that sense. So it's really important to understand the legislation such as privacy, data protection, the cybersecurity requirements, as well as legislation like human rights and non-discrimination. All of these apply to artificial intelligence. And this is important because a lot of people are here, they keep invoking for new AI regulation. Now, why is this really important to regulate the behavior of people around and businesses around artificial intelligence? It's also very important to recognize that AI already exists in a world which is regulated. So, for example, India's recent privacy and data protection bill or applies to artificial intelligence systems when these systems use personally identifiable information. And this is really important because one of the crucial things and risks that we talk about when we talk about AI is really around privacy, is really around data protection. So it's important to understand, I think, that whilst we do need to understand whether existing legislation is fit for the age of AI, we also need to bear in mind that there are existing laws that already apply. There are so many conversations around AI governance at the moment. Just a few weeks ago, there has been a summit in South Korea where leaders from all over the world have gathered together to really look at what governance looks like, what it means to monitor the development of deepfakes, what it means to look at cyber threats, and what it means also to get together behind a set of principles that companies can get behind and countries can get behind. Now, artificial intelligence does not stop at borders, so the international dimensions is very, very important. And countries and different jurisdictions will also set the rules. The European Union, for example, has recently enacted the European AI Act, which is a risk-based legislation, and wraps controls around artificial intelligence systems based on the risk that they pose to health and safety, as well to fundamental rights. So there is a big discussion happening everywhere around the world around governance that is both global and has to happen within the AI strategy that have been developed within countries. Certainly, India is.
So let me take that forward. In the Indian context, there are a couple of sort of conversation points. Do you keep this light touch? Do you have stringent guardrails? Also, there is a unique perspective to look at, right? We are going to be or are already some of the largest data generators of the world because it's a large population. You also have the risks of inequalities increasing because of AI. Access, not being fair because of AI. Do you think all of those things also need to be kept in mind? Because we'll wait now for what the Indian version of AI policy looks like. Will these be key touchstones?
Yeah, I mean, this is a great question. And obviously, we will see with the political development in India, the sort of new political setup, how the debate will evolve. And I think it's correct. There are different ways of looking at things, but I don't think that every country will do it in the same way, in the sense that I think it's important to understand that there is a global conversation around artificial intelligence. For example, in South Korea and before in Bletchley Park, India was there alongside many other countries. So there is a global conversation. And I think there is now an understanding that in order to harness the value of artificial intelligence, we need to look at exactly the issues that you mentioned. So, for example, the issue of fairness in artificial intelligence systems, not just in terms of access to the systems and access to the digital realm, which obviously acts as an equalizer of opportunities, but also the inherent bias that can happen within the systems. Issues around cybersecurity. I think there is an alignment all around the world that there are a set of risks that need to be managed. Whether this happens through regulation, whether this happens through business self-regulation, or whether this happens through standards, there are many different ways of doing this. But I do think that there is some alignment around the world on recognizes what the risks are. Certainly, India is in a unique position. It's a huge country that generates a lot of data, and also a country that makes and can make a huge opportunity in, for example, and a huge presence in the discussions at global level around AI for the common good, what it means to shape an ethical AI, and what it means to use and leverage artificial intelligence to solve some of the biggest issues that we have these days. So I think it will be interesting to see what happens next, but there is no one way of govern AI. There is no one way. The European AI Act, for example, is the first AI-specific legislation. And the jury's out there to see what is the best way to govern artificial intelligence moving forward.
If you look at the bottom line, clearly there is what I would say an exaggerated growth in profitability as measured against the previous year, where several of our businesses were not making money. An additional feature that we have is the cost benefits, the savings of costs that we established during the pandemic, and we continue to hold on to most of it at the moment. Most of our businesses cut their costs significantly, and even though that they are in recovery, they've managed to upgrade their technology, and therefore the need for the same number of people as we did pre-COVID is no longer required. So yes, revenues will continue to grow, and if I look at forward bookings in the India businesses, which represent the core of our group, clearly I'm seeing growth over the previous season, and this will get reflected in 24-25. So I'm fairly hopeful that we will register another year of growth, both at the revenue line and the profit line.
Look, while you are trying, can continue or not continue.
Hello and welcome to NDTV Profit. You're watching Talking Point, and our case for chat today is: will the Fed cut interest rate in 2024? What is the outlook on Indian markets post-election? And in foreign fund flows, it's India versus China. And joining me today is Harold van der Lind, who is the head of equity strategy Asia Pacific at HSBC. Harold, thank you very much for joining us on NDTV Profit. My first question to you is on the Fed rate that happened yesterday. What is your view? Will the Fed go ahead with the first rate cut in 2024?
Yeah, well, thanks for having me on your show as well. If you look at inflation just over the last, say, 2 or 3 years or so, you basically see a very nice increase and a very nice decline. And the numbers that we see now suggest there's a continuous decline. So yes, I think they will be cutting interest rates. Now, the timing of that is then going to be important. That's what you're asking for. And I suspect in the second half of the year, they will have to do one cut. What normally happens is that when they start cutting, they will continue to cut. So normally, I expect this to repeat itself again. They will wait until they're very sure they need to cut, and then you see successive cuts coming through. But if you look at the overall trend in inflation numbers in the US, I think there's no doubt in mind, actually, that they're going to lower these interest rates. And second half of the year is a good guess. Well, that's easy to say. It's June at the moment, but let's say from September onwards or so.
If you look at the inflation numbers also, which came in last evening, we've seen inflation to be very sticky. In the month of May, it hardly moved. So do you see inflation heading lower from here on in the next couple of months for the Fed to take the first decision on rate cut?
Yeah, I think, of course, they will be looking for further confirmation that these numbers are going to go down. But overall, I think the direction of travel is in my view, fairly clear. But you're right. Inflation in the US has proven to be quite sticky. And I think there's a lot of things going on. There's a shift, for example, in the structure of the economy. Services are doing, for example, manufacturing. It seems like strength in the US economy has simply caught us a little bit by surprise. It's been stronger, therefore employment has been stronger, demand has been stronger, and these sort of things that's helped us. That's made that inflation number a little bit more sticky as well. So that's absolutely right. But if you look at the trend over the last, let's say, what is it now, 12 months or something like that, it looks like every time it's moving lower or stabilizing, but it doesn't look like it's moving in the opposite direction. So I think the direction of travel is clear, but the speed at which the inflation number is going to come down is slower than anticipated, at least what we anticipated at the beginning of the year. You're absolutely right.
When do you see actually a directional, commentary coming from the Fed with respect to a lower rate? Because today the bias is towards ensuring that the inflation is managed well. They're not worried so much about the growth because growth is coming in. But as far as the rate cut is there, it's more of a bias of how to manage inflation. So when do you see that commentary changing? Because normally the Fed starts early commentary before it actually takes a rate action in either direction.
Yeah, no, that's right. So at the moment, they've put themselves kind of in a holding pattern. And I think they just want to get a clear indication that inflation numbers is getting to levels where they start to think it's moving towards uncomfortably low levels. So if, for example, we see that can either be that we see successive declines, or we see maybe in the next month or so a big decline or something like that, then I wouldn't be surprised they say, oh, we really need to start cutting rates. They need to see that being confirmed in other areas as well. The problem in the US is at the moment that simply demand outstrips supply, that there is the overriding economy, demand side, employment, these sort of things is just doing pretty good. And that shows signs of slowing, but yeah, that's a real slow process. So I think they're looking for real evidence. The worry is, of course, if they go too early and the inflation numbers pop up again, or again be very slow in responding to this, and therefore don't go down so quickly, then they might be seen by the market as being pulling the gun too early, and that dawns their reputation. So they're right in what they do in that sense. I think they're waiting for clear evidence. The market at the beginning of the year said, you need to be very aggressive and you need to cut interest rates 5-6 times this year. Clearly, the market had to recalibrate its own expectations and storyline as well. So it's good that the Fed didn't just listen to the market, but kept on hold in the first half of this year.
Mm-hmm. Back in India, we had the elections and we have the results out, and the government is back in power with almost all the key ministries with the leading party, which is the BJP. How do you see the flow of reforms from here on? Do you see some kind of change or focus changing for the government going ahead?
No, I think, first of all, the win, I think, for India was a good win. It creates a sense of political stability, but also not at the expense of the reform momentum. What we're expecting to see at the moment is broadly a continuation of the sort of policies that have been put in place, for the very simple reason that it's the same party and leadership is still in place. However, that there will be a shift probably towards more focus on welfare spending. We've seen a kind of disjunction between rural recovery and urban recovery in India, urban recovery being very strong, rural recovery being much lower. So something to deal with that particular imbalance is probably important. And some sort of welfare spending or whatever that might be, we'll have to see in details, but I suspect that's going to be on the cards.
And is that spending well within the macroeconomic framework, which or the glide path, which was provided at the time of interim budget? You expect that to remain there, the glide path of fiscal discipline, or is it going to some way change or alter that?
No, I think I would be very surprised if this would go at the expense of fiscal discipline, that they do this in a very disciplined way. Why so? Because in the past, they've gone out of the way almost to show that they are very disciplined about spending programs, not overspending, not ramping up the budget way too far, and these sort of things. India might have well learned its lessons from the past. If you run a significant budget deficit, that can be in itself much more costly than the benefits that such a aggressive budget generates. So they've gone out of their way to make sure that they put that discipline in place. So I would find it a kind of odd or unexpected if they would move in the opposite direction at this moment. So I don't think that's a particular working assumption for us. So more welfare spending, but probably limited in that sense, or maybe they have to resize some of the priorities and think, okay, we're not going to do this, but we're going to do that. and these sort of things.
One of the big things which is there is the earnings growth for the Indian companies. It's been growing at over 30% in the last quarter. How do you see the earnings growth momentum going into the next financial year? Do you see that to be sustainable? That's to be sustainable, and when you couple that with the fact that in India also there is an expectation of a rate cut happening at some point in time when inflation comes into control, how do you see the Indian rate cycle also playing out?
Yeah, well, let's start with the rate cycle first. I think across the whole region, all central banks are watching what the Fed is doing. There are other countries, Philippines is a nice example, where it looks like inflation is going to come down. They probably have quite some room to cut interest rates, but are they willing to do so? At the moment, not, because the currency is weak, and if they are too early and the Fed is not doing anything, that might exacerbate the situation. So a lot of countries are like the Philippines. India is no exception to that. They probably would like to cut, but they don't want to do that before the Fed is doing it, because the risk is, if you do that, that the Fed is later, your currency is going to be weaker, and then imports inflation, and it's going to offset things. So they're all waiting for the Fed to move. But in regards to earnings growth, is the 30% earnings growth that came through in the first quarter sustainable? No, I don't think so. That will come down. But is high growth sustainable, meaning anywhere between 15 to 20% over the course of the next, let's say, 3 years or something like that in India? Yes, I think that is that is quite achievable, because the drivers of the underlying growth are structural in nature, but also not dependent always on policy. We have an inflow of investments. We have a development of urban consumption taking place. We have the benefits from better infrastructure investments over the last, say, 5, 6, 7 years coming through. And most importantly, they've seen a cleanup in the banking system. The NPLs are down, so the credit costs are down. The ability to extend loans by banks is also much better. All of that will, at some point in time, taper off. These are kind of one-off things that really boost growth, but at some point in time taper off. But I suspect that will take a few years before that really materializes. So is good, healthy 15 to 20% earnings growth possible over the next 3 years, if that we call sustainable? Yes, I think. Is the Q1 number of about, say, 30% or so sustainable? That's probably a bit too high to ask for.
If that's a scenario, what is your take on various sectors within the economy? Are you moving away from some and entering new? Because we saw some sectors like the FMCG and others been laggard last year, but we saw some kind of revival coming in. If you look at foreign flows, foreign flows have been foreigners have been exiting some of the financials there. IT has seen some kind of revival with respect to flows and the run up which we saw. So where do you see various sectors within the economy here?
Yeah, so IT, you're right, has seen a bit of a revival, because the underlying, and this comes back to what we said about the US economy, is doing better than what we initially anticipated. Everybody was talking about a recession in the US 12, 18 months ago. That has just not materialized. So that's good. If interest rates go lower, that's probably not so fantastic for the banks either, but I do think that the banks look reasonably okay. The thing with India is it's not so much growth. We see decent growth in quite a few sectors, but the problem is really valuation. Certain sectors are really expensive. So I'd like to go down the valuation yield curve a little bit, if you want to call it like that. And look for sectors where growth is okay, but the valuations are reasonable, and banks fit into that. One sector where valuations are really high, but again, the growth is highly visible, is the consumer sector. It's probably one of the most interesting sectors in the region, but Indian consumers in general. But yeah, it is pretty pricey, and I don't think that is going to change. But that plays into all the different themes that we spoke about. The better infrastructure build out that allows for businesses to grow and employment, better consumption. You see formal retail gaining market share over informal retail. The inflow of FDI is good for employment as well. Again, that is good for consumption. So a lot of these long-term drivers for Indian growth at the moment all come together in the consumer sector. So yeah, no surprise that that's rather expensive. So I would be fairly selective on that particular front.
Two sectors that I want to discuss with you is IT. You briefly spoke about the fact that US is recovering, so you're going to see some kind of recovery happening in IT. Do you see the earnings also improving for some of them, because guidance have been very muted for them for the coming year? We saw volume growth been very low for many of them. Do you see that because now that you are seeing a strong growth in services side and some bit of recovery in manufacturing in the US, you're going to see some kind of order flows and growth coming back to some of the Indian IT companies?
Yeah, so basically, for the IT sector, insofar they sell, in particular the ones that sell into the US, probably have expected that the US will be in a recession now and that business will be very weak. That has not materialized, that has not happened. So therefore, that underlying business is okay. The currency is weakened as well. That means actually that their US dollar business has been repriced to a certain extent in rupee terms, so that has helped them as well. And I think that is driving that particular sector at the moment. But if I look 12 months out, most likely that business will slow a little bit. That remains a risk to that particular sector. So it's a sector that I structurally like, but I think it's at a nice rally. I think I'd maybe prefer the banks a little bit better at this particular point in time.
Harold, stay on with us. We're just going into a break. When we come back, we'll discuss some of the other sectors and fund flows and how India is stacking up against China. Stay tuned to Talking Point.
So I think we are pretty happy with obviously with the finance minister and also with the power minister, the railway ministry, with Mr. Vaishnav continuing in the railway ministry. Power ministry, obviously we have seen a change with Mr. R.K. Singh going out and Mr. Manohar Khattar taking over. So I think that we will keep on watching. Railway, we do expect that despite continuity, I think we are hoping that there's a change in the priorities of the railways. Because till now, the last couple of years, we were seeing the priorities more on, running more trains and sort of rebuilding stations, etc. And a little bit less focus on the infra build. I do hope that now, this year onwards, we'll start seeing a lot more infra build happening in the railway sector, which would be tracks and, signaling. Today, Vande Bharat is running at 70, 80 kilometers instead of 140. So a lot of investment will have to be made, at the ground, to ensure that we achieve the optimum, capacity, etc.
Look, while you are trying to get in.
Welcome back to Talking Point, and my guest today is Harold van der Linden. Harold, we're talking about the IT sector before the break. I want you to, touch point with some of the consumer sector. You still said, you continue to believe that it's still overvalued, but many of these companies are high growth companies, high margin companies compared to the regional peers and competitors. So, what is it that makes them still very expensive, and where do you see ideally flows coming into these companies, or when do you see the flows coming back to these companies?
I think the reason why a lot of people think that they are expensive is because of their good growth. And I don't think that is the case. I think the secret to success, particularly in the consumer sector in India, is distribution, the capabilities to distribute. If you come in as a new player in India and you want to set up a business, that's not easy. And in particular, getting your product across the country is very, very difficult. The Indian consumer market is geographically much more diverse than, for example, the Indonesian or the Chinese consumer market, where most consumers are located in a few large cities. India's, the difficulty in building out a consumer business in India has got to do with distribution. Being able to get your product to all sorts of smaller towns and literally having people on a bicycle bringing from one town and one village to another one. Now, if you can do that, you can become incredibly profitable. And I think this is the success to the high profitability of Indian consumer companies. They are the most profitable companies on planet Earth, simply. I mean, you have companies that are basically more profitable than the ROEs 60, 70, 80%. That's higher than most of the AI companies in the US or Asia that people are looking at these days as well. So those incredible levels of profitability and the ability to generate cash flow, that should be rewarded, and that is rewarded in markets, and that's where the high valuation comes from. So it's not necessarily the growth, but really the profitability and cash generative kind of nature of these businesses. But yeah, the valuations are high, and this is what you therefore see when it comes to foreign investors. They always say, we like the Indian story, we don't have to talk about this, but isn't it really expensive? So what that happens is they think it's expensive, rightly so. The PEs are very high, price to book levels are high. But the moment it comes down, you see them coming in. So although we've seen outflows from the Indian equity market, actually mutual funds, they are buying on the dips in India.
I think mutual funds are much more smarter than foreign investors because one, they have real retail investors putting in money there, nearly $2 to $3 billion coming in every month through SIPs, through the mutual fund route coming in, and that's preventing these companies from correcting so that the foreign investors can come in here.
Yeah, I mean, domestic firms are buying up the equities through these SIP plans, the plans that you just referred to. That's right. You see this across the whole of the region, actually. Domestic investors, Asian investors are really buying into Asian equity stories. So it's not just India, but we see this in Thailand. We see this early signs in Indonesia. China has happened already, Korea, Taiwan. But in India, it is quite a impactful force, partially also because a lot of retail investors are unable to bring all of their money outside of India. Most of it has to be reinvested in India. So yeah, domestic buying is very strong, and that crowds out the foreign investors who say, well, it's too expensive for me, I'm out. So the domestics are buying it up and are less price sensitive. And that is another reason why the Indian markets are expensive. But as I said, that comes also with good profitability of these companies. So, yeah.
It's creating a fear of missing out as well?
There are, I think maybe sometimes the fear of missing out. That happens very often if markets are really rallying very quickly. People are wrongly positioned. Most foreign funds are well positioned in India. So it's not that they're fear of missing out. But if the Indian domestic investor continues to crowd them out, you get a situation whereby the foreign say, well, it's very expensive, but if this market continues to perform, I need to get exposure to this. I've been sold out. I need to get back into this. That could well happen, yeah.
Another sector which is seeing a lot of discussion and where the cash flows are now emerging because that's into maturity stage is the infra space, where the money cash flows have started coming in, whether it's ports, roads, or or any other infrastructure which is being put up. Do you see that foreign investors would be more interested in those companies because now they've reached a maturity or where cash flows are much more predictable and growth is much more sustainable?
So when it comes to infrastructure build out, I think what I see in India is something that I saw 15 years ago in Indonesia. I was in Tamil Nadu a couple of months ago and I took a trip. I like temples, so I went to see a bunch of temples, Tanjavur and places as such. What happened is that you're on a highway, but you drive for maybe 10, 15 kilometers on a highway. Then you have to get off and you get through the paddy fields and stuff like that, small roads, until you get another segment of the highway that have been constructed. So a lot of that infrastructure is not really being built out. So that means in the near term, it's good business for the construction companies, the infrastructure companies that can that have to put these roads in place. But what we've seen in other markets is that the way to play this is actually through the consumer sector or the services sector, because the moment these railways are done, more business is going to go around, more trucks, you need more restaurants, you need more hotels. All sorts of new businesses enter there. That means also factories can go to a new location. That creates employment in that new sort of town that is now better connected to a highway system and these sort of things. That is one of the key stories that's unfolding in Indonesia, for example, at the moment. And I suspect that's what we're going to see in India over time as well. So the way to play this, I think, is really, yes, at the moment, some of the infrastructure companies and construction companies will have good order flow. But really, it's the consumer companies that are operating in these business, in these areas and geographies that are much better connected in no time soon, that will be the real beneficiaries of this.
In all this, Harold, how do you look at fund flows? Because we've seen, HSEI, jumping the most, nearly 38% year to date, more than 30%. You have the CSI, which is up more than 13%. Indian markets have not rallied that much, and we've seen flows moving towards China. Even after a lot of flows going to China, China is still at a lower average, lower than the 5-year average in terms of valuation. How do you see flows between India and China? You have a growth story here. You have, but there is an issue with valuation in some of the pockets there. At the same time, you have China where the growth story is not that much. It's more supply, oversupplied story there, and there is no, the earnings growth is not as much as India growth.
Yeah, the core problem in China is oversupply. Oversupply means you produce more than you consume. There's a lack of consumption. There's just not enough. They try to export, and this comes with all sorts of other problems as well. And if you can't export it, you got to lower your prices. So that's why you get a sort of deflationary sort of environment in China, and that means also that they can lower interest rates. That's the story in China. What we've seen in China, that rebound that has taken place, is really driven by a large extent to a repositioning of funds. They were very negative on China since the beginning of the year. Then there was the realization that the US pension funds, which publicly had stated that they were going to reduce exposure to the US, that their selling had stopped. That took selling out of the market, and suddenly people thought, hey, this market can suddenly rally a bit, and there you go. They have repositioned themselves, and that allowed that market to perform. But in my conversations, in say, for example, in China, but also in Taiwan and Korea, is that a lot of people are looking at that, but they also bring up India as well. There's a tremendous interest, for example, in Korea, but in Taiwan, and Japan, on Indian equities. So I think the fundamental story in China is very difficult, but people were wrongly positioned and needed to rebalance. They've mostly done so. The fundamental story in India is much healthier, but that is well priced in. So we've seen a near-term sort of reshift of focus. But if it comes to the next 2 or 3 years, I think a lot of people would be more comfortable with their investments in India than in China. We like both markets, actually, but this is, I think, the general sentiment. So have we seen some flows from India going into China? I think maybe not as much as you think. I think there's been money coming out of Japan and some of the other markets also from outside of the region that has gone into China. Yes, we have the suspicion that hedge funds have sold down India to buy China. However, if we look at the long-only mutual funds, a lot of them actually have increased their weighting in India. So these people have sticked with India.
Mm-hmm. So between these Asian countries where the flows are moving, how do you rate India and how do you rate China?
At the moment, we like both markets for very different reasons. China is cheap and well-positioned, but has massive challenges. So when you're taking a tactical view on it, India we like for more structural reasons, as I mentioned earlier on. I don't really have, therefore, a big preference of one over the other. If you would say to me, I put my money in the market now and I want to invest literally for the next 5 years or something like that, then I would say, hey, maybe India, the story looks a little bit better and there's more uncertainty to the direction that China is taking yet. So then I would have a small preference for it. But rating-wise, we like both markets at this moment.
Finally, Harold, what's the one risk that you see investing in India or in China?
The one drift, you mean the risk?
Yeah.
Yeah. I mean, there's always sorts of risks, geopolitical risks and these sort of things. I think the risks lie maybe with the equity investor in India, I think it might well be we've had a nice rally and companies have performed very well. We got to be careful that some of these valuations don't run away from ourselves. So in India, we had a big rally in small and mid caps last year. The stock exchange came out and said, listen, that's fine, you can buy these, but just be very careful. They made some warnings. And I think that's very good that they did so, because sometimes you get this kind of fear of missing out, as you mentioned earlier on. People want to participate in something and put money where maybe in the long run it's not so wise to do so. I think so. Sometimes in India you see this sort of exuberance taking place in certain sectors, so we have to be a bit careful with that. China, the risks are very different. The risk is simply that they need to put policies in place to deal with the overcapacity, and at the moment, yeah, that's a bit difficult to see how they're going to address that in the very near term. So we have to get more signals on that front. But that is the ultimate problem in China, a lack of demand. The risk is maybe that they're not doing too much on the demand side in China.
Fair enough, Harold. It was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit. You were watching Harold Vanderlinde. He's the head of equity strategy Asia Pacific at HSBC. Thank you for joining us on NDTV Profit.
I would say, as you rightly said, 2 to 3 years ago, the discounting which PSUs had compared to the private was huge. That discounting is now narrowing down. The productivity which PSUs were working with were much lower than the private, and that productivity, debatably, is pretty much as where the private is. Then it comes to opportunities which PSU have against the private. And, case in point, let's say defense. In defense, the PSUs have a lot more capacity. They're getting a lot more orders. I guess, the Indian government is giving Indian owned companies more orders, and they've become monopolistic leaders. So you can't make a generic comment on PSUs now going ahead that as a basket would do well. But what you can say is, if you can see the balance sheet and being high quality, which means no debt, good cash, if you can see an order book which PSUs have, that's in manufacturing or in defense, then you're there. Valuations a lot more as far as PSUs are concerned. For banks, are relatively still cheaper than the private, but even the private have got derated a lot. But apart from that basket, I cannot make a generic comment now that PSUs are going to be doing as well as they've done in the last 2 years. It's all now about bottom up, picking the stocks in the PSU you like.
Look, while you are trying to get...
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve. Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit, and my name is Alex Matthew. This show gets you answers to all of your stock-related questions, and to that end, if you've got those for us, you can send them on any one of our social media platforms or that number that you see at the bottom of your screen. That is the number that I have on my laptop in front of me as well, and I will speak to you directly. For now, let's turn to the equity markets and see what's happening. It's a decent day, or it has been broadly. There's still quite a bit of chop and churn. Remember, this is the weekly expiry also to account for, so it's par for the course, that volatility that you're seeing and that chop and churn that you're seeing. The broader market's actually looking quite sanguine at this point, or rather better than the benchmark index. In fact, gaining about 0.5%, the mid-cap index, and up about 0.4% for the small-cap index. Broadly, I would think that the market breadth is in favor of the advances. Among the key indices that are moving today, let's take a look at the sectoral movers. And in fact, the IT index is doing reasonably well. Actually, that last graphic point was interesting because over the last, say, 15 minutes or so, you've probably seen a shift in the advance decline ratio, still tilted in favor of the advances, but less so than earlier on in the session. Among the sectors, as I was pointing out, realty continues to be a gainer in trade, up about 2% or thereabouts, and you have IT as a pack that is doing reasonably well. Media is losing ground, and so is FMCG. The banking index is not doing too much. It's just about flat in trade right now. There is a pack of companies that has been in the news. I don't think that it's moving very much, and I'm talking about the life insurance space. So let's pull up some of those names. HDFC Life, as well as SBI Life, Max Life, the Life Insurance Corporation of India, completely flat right now. Let's pull up HDFC Life. It's up about 4%. Now, the news here is that there was a master circular that was issued by the insurance regulator last night, and we're still trying to parse the details. A lot of these details will emerge over the course of today, and the fine print is actually going to throw up a lot more. But directionally, one of the biggest announcements has to do with the special surrender value. And what that means is, if you are a buyer of an insurance product, of a life insurance product, and I'm talking about your money back policies or your traditional policies, which account for a bulk of the insurance products that are sold in the life insurance space, if you find that you can't pay the premium during the course of that policy, and if you decide that you want to return it, as things stand right now, the amount that you get as a surrender value, that is what is returned to you for what you've paid so far, is not very large. And in fact, it's so small that it's almost like a penalty to you as a policy holder, and it is something that has benefited the insurance industry for a large number of years. What is being suggested directionally is that the surrender value will go up from this point, and as a result of which the incidence of mis-selling should come down. How that will play out is something that we will have to discuss. And by the way, we will be speaking about this in more detail at 12 p.m. But from the perspective of you, the policy holder. For now, let's talk about the insurance companies. And I'm joined by Brijesh Singh, the Senior Technical Analyst at Opulent Investment Advisor Private Limited, as well as Shahina Mukaddam, who is an independent fundamental advisor. I believe that China is joining in some time. All right, so we only have Brijesh right now. Brijesh, thanks so much for taking the time, and pleasure having you on the program as always. Why don't we talk about a couple of the about the moves that you're currently seeing in the market? Chop and churn continues today. What are the key levels that you're looking at for the benchmark index, and where are you seeing strength?
So good morning, Alex. Thanks for calling me on your show. So if we look out the Nifty still has been consolidating in the range. The range, if I talk about, is 23,000 or say 23,100 on the downside, followed by 23,450 or say 23,500 mark on the higher side. Still, it's better. It's been consolidated near this resistance zone rather than towards the support zone. So any closing above 23,450 would be a good point for the market to move towards the level of 23,800 or 23,900 we can see in coming days. Regarding the bank Nifty has been considered same pattern formation has been there as the Nifty has been doing. Downside, if we talk about 49,400, 49,500 is a support band, followed by 50,200 to 50,250 on a a higher side of the resistance band. So it's been consolidating in the range, and same thing what we have been looking in the Nifty chart as well as in the Bank Nifty, they are consolidating towards the resistance part. So if any closing above 50,250, Bank Nifty we can see a high of say 50,800 to 50,900 in a couple of week time frame. So both indices are positive, but they are trading near the resistance zones. Still on the hourly chart as well as on the daily chart, there are nothing negative part or a weakness not been found out.
Okay, fair point. While we wait for Shaina to join us, why don't we take a few shorter term queries, and several of them already coming through. The first one that I'm taking is from Anbu. Anbu is writing in from Chennai, asking about Marico and asking for a short-term perspective on this. Brijesh, how does it look on the charts? Would you suggest a fresh entry at this point? And what are the targets and key levels to watch for Marico?
So, Alex, if we talk about the shorter term, that means I'm assuming for a couple of month time frame. Now, we look out the Marico chart. We have seen the stock from 512 odd level jumping towards the level of 667, and that was a 667 was a 52-week high, and after that we have seen a profit booking in it. And on the hourly chart or on the shorter term time frame of the chart, we have been seeing a double top formation. Now in today's session, we are seeing stock breaking a shorter term as well as a medium term moving average. They are important. If any closing below a level of 630 would be an indication that further downside can be seen. Now, if we talk about the fresh entry as the risk reward ratio has been considered, then I would be saying that somewhere around 590, 95 around, if it trades, then one can take a long side in it with keeping a strict stop loss of 575 and then play for the target of 635 followed by 660. So right now it's on the sell side rather than on the buy side, but 590-95 is a band where one can take a long call in it.
Okay, fair point. I understand we've got Shaina Mukaddam joining in as well, independent market expert. Shaina, thanks so much for joining in, and always a pleasure having you on the program. We were talking about life insurance stocks, and we've seen some divergent moves this morning, and we're also trying to understand the implications of the master circular that was sent out yesterday. So I did put out a disclaimer at the start of, we don't really understand what the full implications of this will be, but directionally, seemingly, the surrender values are going to go up, and that is being seen as a negative for the industry because a bulk of their products are those traditional non-linked products. What do you think, at least prima facie, the implications will be, and would you be a buyer in any of these insurance companies?
Yeah, well, this discussion has been going on for some time now regarding the surrender value and when it will actually, at what is the level that, and what is the time frame within which they have to fix and pay, and what is the level they will have to pay. So I think the latest news that has come out is that the surrender value has to be can be paid upfront full in the first year itself. So to that extent, I think it's a negative both in terms of the impact on profitability as well as in the cash flow for the life insurance companies. Having said that, I think there will be some who will be more impacted than the others, especially ones in which, the length of the period in which the life insurance policy holders hold it. So some of the companies that will be impacted more would be something like a Max Life, which is where we are seeing some of the impact come in the prices. Also HDFC Life. Some of the insurers which will be lesser affected, but all are affected at the same time, would be something like a LIC, SBI Life. Basically, here the policy holders are holding it for a longer period of time. So I think to that extent, they are slightly better off than the other ones. But I think it is something that was expected to hit negative sentiment, and that is what has actually happened in terms of the clarity.
Got it. All right. We've started taking questions. This next one is from Neetu. And Neetu is asking about a couple of stocks. You don't have to speak about both, Brijesh. Whichever looks stronger from the perspective of 1 year. And of course, you can say buy both, but it's Vodafone Idea as well as IREDA. Both of these stocks have seen quite an interesting run in 2023. I'm not sure if it's moved too much, IREDA, in the near term, though. If we talk about the 1 year, or rather the year-to-date chart for 2024 for IREDA. What would you suggest that they do from the perspective of 1 year though? There you go.
So Alex, if I talk about IREDA, first of all, I would be saying the trend is nothing much in it. It's been flat. If I talk about downside, it has a support at 140, whereas on the higher side, it has a resistance at 210. So if it crosses that 210 mark, then we can see a stock, shooting towards the level of 270 and followed by 320. So till the time 210 doesn't breaks on the higher side, I would be saying that it would be trading in the range of say 140 on the downside followed by 210, whereas the idea has been considered is always if I'm not mistaken 2 or 3 days back all the Birla stocks were moving in that idea also moved up sharply from a level of 12 rupees. It's been trading at 16.35. So any dip below 15 or nearly around 15 around mark, if it trades, then one can take a buy call on it with keeping a stop loss of 12 rupees and then play for the target of 19 and 20. This I'm talking about 3 month to a 6 month time frame, and if any closing above 20, then we can see a major churning in this stocks and then it can shoot up to the level of 25. So right now below 15 would be the ideal bet in it with the stop loss of 12.
I was trying to get at is that these stocks have moved very sharply and then for a while have not really done too much. But Titagar is the next counter that we're talking about, and we've got Rosemary. This is bought intraday. She's bought at 1,438. Let's pull up where the chart is, and it's a relatively short-term question. So possible target and stop loss for today, Brijesh, quick view.
So Alex, if we talk about Titagar wagon has been considered, all the railway company stocks have moved up very sharply. 1430 around the stock has been trading right now. Stock, if it doesn't breaks a level of 1280, then it would be a promising bet for the short term has been considered. So 1280 would be the stop loss which I would be updating as for the viewer. As a resistance wise, I would be saying 1580 would be the first hurdle band. Why? Because previous week high where the supply has come up, so it has to cross that level and then it can move up to the level of 1780 zone. So ideally for a 1 month to a 2 month time frame, 1780 would be the target one can look out, and with the stop loss of 1280.
Okay. I'm actually trying to figure out when you said this, Shaina. One of our viewers has actually shared a conversation and I'm pulling that up right now. It has to do with Motherson Samvardhana. This is about 2 months back, I believe. And Motherson wiring. So he's actually switched from Samvardhana Motherson to wiring based on something that you had said on that day, but he's asking what he should do from this point. If he's holding wiring, should he continue? Should he add more at this juncture?
Well, he can actually, but he should definitely continue holding. There's a lot happening in the overall group. In fact, even in the parent companies, Motherson Sumi, there also a lot is happening in terms of where they are trying to restructure, raise funds, structure the operations. But still, I think Motherson Sumi looks better even at current levels. He can add at any dip and continue holding his position.
Motherson wiring, right?
Yeah, Motherson wiring.
Looks better. All right. The next question we're talking about is IRFC, and this is from Sri Kishore. He's writing in from Motihari in Bihar. He's bought at levels of 66 and he's got a significant quantity, 7,000 shares. He's wondering what his strategy should be for the next 3 years. The stock is currently at 175. Shaina, should he take some money off the table or should he continue holding or even add more?
I think he should take some money off the table. Because in terms of valuation, of course, it's a government company. So, I mean, if you're going to hold it for the very, very long term, there is no issue. But if you compare it with the rest in the overall peer group, the valuations are extremely expensive. It's more than 3 times price to book 1 year forward. So, I would believe that he would be better off taking some money off the table. He can relook at it after a couple of quarters or maybe a year down.
Okay. All right. So there are more questions that are already in front of me, but we have to slip into a very quick break. We'll be back on the other side to take them, so do stay tuned.
I would say, as you rightly said, 2 to 3 years ago, the discounting which PSUs had compared to the private was huge. That discounting is now narrowing down. The productivity which PSUs were working with were much lower than the private, and that productivity, debatably, is pretty much as where the private is. Then it comes to opportunities which PSU have against the private, and case in point, let's say defense. In defense, the PSUs have a lot more capacity. They're getting a lot more orders. I guess the Indian government is giving Indian owned companies more orders, and they've become monopolistic leaders. So you can't make a generic comment on PSUs now going ahead that as a basket would do well. But what you can say is, if you can see the balance sheet and being high quality, which means no debt, good cash, if you can see an order book which PSUs have, that's in manufacturing or in defense, then you're there. Valuations a lot more as far as PSUs are concerned. For banks, are relatively still cheaper than the private, but even the private have got derated a lot. But apart from that basket, I cannot make a generic comment now that PSUs are going to be doing as well as they've done in the last 2 years. It's all now about bottom up, picking the stocks in the PSU you like.
Look, while you are trying to get into a relationship with somebody, you really want to know how much that person really earns.
Welcome back. You're watching Ask Profit, and we're in the midst of taking all of your questions. The next one that I'm taking is from Gautam. He's writing in from Mumbai, and he's asking about Texmo Pipes, which he has bought at levels of 79. The stock is currently trading at very close to that mark, in fact. And he's asking what his strategy should be, whether he should hold or sell these stocks, this particular counter. Brijesh, what's the view on the charts?
So Alex, if we talk about on the daily chart time frame, the stock has been trading with a lower tops and lower bottom formation. So that indicates a negative view. That is one point. Second point, the shorter term moving average as well as the medium term moving average. It's somewhere near the range of say 80 around. The stock is trading below that. So that is also giving a negative sign. Even the previous week high, that was somewhere around 87, that has been broken. Previous month high was 87, that has been broken. Previous week high is somewhere around 80 rupees, 80 paise or 81 rupees. Been trading below that level. So looking on that front, even the strength of the chart is not that much strong. So a single word would be better to exit this stock rather than holding. It can move further down to the level of say 67, 68 rupees.
All right. Avantel is the next counter that we're talking about. China, do you have a view? We've got a viewer, Sushila, who's bought at levels of, I believe. Okay, let's pull up the chart and see where it's currently trading, just so I get an indicator as to where the stock is currently trading. 140 or thereabouts. I believe she's bought at levels of 113. So she's gaining ground. The stock is also buzzing in trade today, up about 4%. China, what's the view?
See, it's a small cap telecommunications company. So as of now, it looks okay. But though profitability was lower in the last quarter, so it's seen a bit of consolidation, but I think it looks okay at current levels, and she can hold it for the medium term.
Let's quickly also get your view on the charts. A quick view, Brijesh, on the charts, how does it look? It's looking strong in trade today.
See, if we look on the daily chart time frame, the stock has been trading with higher bottom formation, which indicates a positivity. I would be only suggesting the as a support, stock should not break 125 odd level. That should be kept as a stop loss. If it holds, then well and very good. Regarding with the resistance wise or the target wise, it has a potential to go 160, 165 in a shorter term time frame. And if I have someone view has a say 3 month or 6 month, then 180 would be the ideal level as a target.
Okay. Relatively short-term question is being asked, but I still am curious what China thinks of Intellect Design Arena. What's the view on this particular counter, China?
Actually, the stock has been, sort of not doing, it's consolidating basically, because if you see the actual numbers, they have been slightly disappointing in terms of the last quarter. If you saw last quarter, profits were lower. So I would say it is a stock that one will consolidate for some time, and the numbers will improve. They have got good products, R&D is good, so one can continue holding with stop loss.
Okay, fair point. I do want to point out that Manju is asking about IRFC. We've already taken that counter, so I will try and take others. We've got Ramesh Chandra Srivastava who's asking about HLV Limited. Any chance you have a view on this, Shahina? It's a stock that Ramesh bought at levels of 22 and it's currently trading at 26. Any view on this?
Well, it's in the hotel business. It's a small cap actually. So it's done pretty well for itself over if you take a little longer period of 3 to 4 years. But in terms of financials, actually, they are improving, but it's a slow, steady performance. Last quarter also, if you saw, numbers were a little bit lower, but the overall sector is doing well. So here again, I will say one can hold, keep a stop loss.
Okay, fair point. HDFC Bank, it's not a stock that we hear about from our viewers, interestingly, on the short-term time frames. But we've got Vishal who's bought 500 shares at levels of 1,488. The stock is currently trading above that, about 100 rupees above that. And the question is for Brijesh, short-term advice. What are the key levels to watch for HDFC Bank?
So I would be suggesting to hold on with the stop loss of 1535 around is a support. So keep that thing as a stop loss. If it doesn't break, then no problem for it. As well as on the higher side, the resistance would be 1605. If we are able to cross that level, then the next level to watch would be 1660 to 1670. I'm talking about very short term time frame, say a week or a couple of week time frame. So first of all, trend is positive. 1535 would be the ideal stop loss and play for the target of 1660 to 1670 odd.
Okay, Manju's got the next question asking for stock related advice, but has not provided us with a time frame. I would encourage everybody writing in to tell us what your time frame is, whether it's less than a year or more than a year. That will help us direct the question to who might be more appropriate. But the question is on Yes Bank. And Shahina, I'm curious about what you think about this particular bank. There's lots been said and the ownership is well known. Would you say that somebody can buy for the long term?
Let me say yes, but it's a risky stock. It all depends on what call SBI takes in terms of transfer of its holdings. It holds, of course, the majority stake along with the government also. So to that extent, it's a risky stock, but I would say one can at least hold if you're holding it. And if you want to buy, I think there are better stocks available which are less risky in the overall banking space. You can even go for the large banks. In the smaller banks also, you have something like a Federal Bank, which I think is safer. But Yes Bank, you can hold if you're holding it.
If you are holding it. All right. Power Grid Corporation of India is the next counter that we're talking about. We've got Saurabh, who's got 500 that he's bought at levels of 319. The stock is currently trading just above that price, so it's not very high. He's not making a lot of money. He's thinking of holding for the next 2 to 3 years. Shahina, a lot has been said in the run-up to the elections about policy, about the requirement for power and all of that. Power Grid, though, some might say that the valuations are a tad bit stretched. Would you also buy into that, and would you hold on for the next 2 to 3 years?
Yeah, valuations are stretched. If you look at the price to book basis, it's more than 3 times, current year, which is actually expensive for a capital intensive industry. At the same time, I think things are looking up for the overall sector. So you can hold, but being a PSU, you can expect reasonable returns. Don't expect it to be a multi-bagger over the next 1 to 3 years.
Okay. Hudco, it's a stock that has been doing quite well based on the expectation for housing and the policy on housing that has been announced by the government, and it's down about 1/3% today, but in the recent past, I do not know if we can pull up the 1-month chart for Hudco, but that should indicate that it's seen considerable amount of buying. There you go, close to 30% in just the last month. We've got a question coming in. Okay, Himanshu Thakur is writing in from Delhi and asking whether it can be bought at the current market price for the next 6 months maximum. Brijesh, what's the view on the charts?
So Alex, I would be saying first of all the trend is positive, but buying at this level I would not be suggesting. Risk reward ratio are not in the favor. See, if we look about a daily chart from 14th of March, the stock had made a low of 151, and from there we have seen stock almost getting double. It made a high of say 300 on 3rd of June, and after that we are seeing consolidation. So ideal level to buy would be somewhere around 250 to 260 odd level with the stop loss of 220 around, and then look for the target of 320 or say 340 odd level in a 6 month or plus time frame. So at this level I would be avoiding. Let it go and settle around 250 260, then your risk reward ratio would be in your favor. So just wait and watch. Probabilities are there because since stock had shooted up and it's been the gap has to be filled, so it would be coming down and the gap would be filling up.
Okay. Now, one group of stocks that did quite well in the last week is the Adani group of stocks, and Adani Enterprises specifically. We've got Vrishali from Mumbai who bought at slightly elevated levels in the 3rd of June rally and averaged at a price of 3,320. What she's asking is, what is the likelihood of it reclaiming the 3,600 mark quickly, and what the outlook on the stock is? Shaina, what would you suggest that she do? Should she hold on, and what advice can you give her?
Well, it does look like if you're holding for the medium term 6 months, the stock will give you a better rally because I think most of the group companies are doing better. So to that extent, one can hold. You can keep a stop loss. I would suggest you can keep a stop loss of somewhere close to about 3,000.
Okay. Just a quick standard disclaimer, as we normally do. This is NDTV Profit, part of the NDTV Group, and it is owned by the Adani Group. That brings us to the end of this particular edition of Ask Profit. Shaina as well as Brijesh, thank you so much for joining in and for answering all of the questions that you did answer. And viewers, we try to accommodate as many of your questions as possible. Understandably, we cannot take all of them, but hopefully the ones that we've discussed today, the stocks, have benefited you in some way as well. That brings us to the end of this program. Thanks so much for watching. This is NDTV Profit.
The war is completely shifted towards drone-based attacks. Even Elon Musk said the warfare is going to be drones versus drones, not human beings versus human beings. So I think the counter drone systems and the whole of drone ecosystem is going to get a very big boost in the next 5 years. And the second is the amount of combat readiness. You may be having Iron Dome and all that, but people are coming in with hand gliders and taking over the country. That means something, the preparedness, lack of preparedness, something. Even when we look at Ukraine, it has world's most advanced equipment gifted, but it's not able to operate it. And with vintage equipment, Russia is able to really inflict tremendous damage on Ukraine. So training is going to become the second most important thing after the drone ecosystem development.
Look, while you are trying to...
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies.
Welcome back. You're watching India Market Close here on NDTV Profit. Now we have Agam standing by as always at this point to break down the F&O cues for the day. Agam, what's the F&O data indicating?
Well, it's another quiet afternoon. At the moment, what we're seeing is not too much traction with respect to the Nifty, continuing to trade around 23,400. As you can see on the spot, there have been a lot of bets placed where there's a lot of calls being sold around 23,400, and it does seem like it's very unlikely that the Nifty will close about that. Of course, the last half an hour average will be taken into consideration now, in terms of the closure. But we, a lot of traders who have already written the 23,400 calls earlier in the session are probably already sitting in the profit if they haven't already booked out. In terms of your Bank Nifty, again, we're keeping an eye on 50,000, pardon me, but we've seen Bank Nifty step away from that mark. At the moment, again, not too much traction with respect to the change in OI. If you consider the options market, as I was suggesting, a lot of writing around 23,400 in terms of calls, and some amount of writing in the puts as well. So if you had written a straddle at 23,400 this morning, you would have been sitting at a pretty reasonable profit at the moment. And in terms of the stocks, again, Oracle Financial Services continues to move up. In fact, at one point in time, it had hit the 10% F&O circuit. And besides that, we have longs in Max Financial. Dixon Technology is also now picking up steam, up 5%, as is the case for LTF. And among stocks which are seeing unwinding, MGL, Atul, and Coforge looking at about a short covering. A mixed market, but more pros and cons, more gainers and losers, and that continues to be the case. But consolidation for the benchmark continues.
Well, consolidation for the benchmark continues. Thanks so much for that, Agam. One pack of stocks which is doing very well again in trade today, you have the defense pack in focus. Look at a BEL, look at a Cochin Shipyard, look at a Garden Reach up 11.5%. Garden Reach, HAL also up 4+% in trade. You also had Rajnath Singh, the defense minister, talk about further strengthening the domestic defense manufacturing and boosting exports to unprecedented highs. Now, this comes at a point when, in any case, you have some of these defense stocks trading at decently high and elevated valuations, relative valuations. Let me put it that way. Dharmesh, your sense with regard to the whole defense pack at this point? Just this comment coming in from the defense minister. What's your sense with regard to defense as a play as of now, just in terms of both execution and valuations?
Yes, I mean, we were very constructive on this play, and that's the reason why we have included defense stocks in our budget theme as well. And both HAL is there, and one of our initiating coverage D6 system is there. See, the reason why we were still constructive on the defense stocks in spite of it being traded at multi-year high valuation multiples was that there has been a conceptual shift for the defense companies as far as the way, the type of business they are getting. Earlier, it was IOP kind of a partners for Indian defense companies, that is Indian offset partners. So around 30% of the component which India was sourcing from overseas was being made in India, but it was not actually made in India. It was more of an assembly kind of a system, assembly, packaging, testing, and the product was given back to that company, and the finished product used to come to India. It can be anything: artillery, aircraft, helicopters, tanks, and things like that. With Make in India concept, what government has did a change is now you have to transfer the technology for that product to be manufactured in India. And there are 3 stages: 1, 2, 3, 30%, 40%, 50%. So on an average, the new deals which these companies are doing, basically the government companies, when the government is sourcing a product from overseas, so they have to tie up with an Indian company, and then this percentage has to be manufactured in India. The beauty of that is the technology transfer is also happening. And eventually the 100% will have to come to Indian companies to be manufactured, and those companies will take the royalty premium kind of a thing. And that's the reason why we are seeing this blue sky kind of an environment for most of the defense companies like HL. The entire LCA, that is light combat aircraft or light combat helicopters, will be manufactured in India. The Rafale deal has been in light with the same 7 to 8 years hence forward. It is going to happen like that. So as of now, order book is going well. The 12-13% kind of a revenue run rate is there. But if you have looked at the operating margins, they have swelled 200 to 300 basis points. And this was not because of low input prices. This is because the product, they have now shifted from services maintenance to product kind of companies. And that is helping. So again, my only sincere advice would be very kind to selection of criteria. be strict with your procedures when you are buying a defense company. But this is an unfolding story. So this kind of a premium valuation may continue for 2-3 years kind of a time frame. Our top pick in the system is HAL, that is HL, and DCX system.
I was going through that list of yours, Dharmesh, and I noticed not just the defense names, and you're absolutely right, DCX and HAL is in it, but a lot of PSUs as well. Now, just to set the context, this is Chola Securities' top budget picks, and RVNL is in that list, which they've rated as accumulate. I also saw IRCON. You have LIC, so a lot of PSUs, Texmaco, so you know, rail. I just want to know why rail stocks in your budget list. I mean, if there's one space which has already run up a fair bit, Dharmesh, it is rail stocks. Why rail stocks for your top budget picks, and why these?
Yeah, definitely. I mean, we try to do a mix of both the growth play and the stability play, where the stickiness of earnings is there. So the railway stocks, railway infra is again into a growth play. And why so? Because I will tell you, if you go 5 years back, the railway budget used to be 40,000 crores to 50,000 crores per annum kind of a thing. It has gone to 2,55,000 crores when the last interim budget was presented. And the target is to go to 3 lakh crores when this is the likely scenario when this time the budget will be presented. So we have seen a 5x growth into the railway budget allocation itself. And that this allocation is an expenditure by the government into the railway infra thing, be it gauge construction or electrification or bullet train, wagon overall, change of new wagons according to the speed limit and all. And all these businesses are going to come to, say, RBNL, which is into the construction part of the business, Texmaco Rail, which is into wagon manufacturing, and Infor International, which takes care of the technology part. So our sense is this kind of a drive, which is a very, very large scale in nature, is likely to continue for some more time. I do agree that valuations have gone up, but the pace at which the market is moving, they are not discounting 2 years or 3 years down the line. They are actually discounting 5 years or 7 years down the line kind of a price target. Same challenge we faced with power companies, but we dropped it from the coverage list just because power companies have done their bit. Railway, I think there's still much more scope left. So that was the reason why we have taken this as a consistent compounder. And the idea was to accumulate them on a SIP basis. That's the reason why we have not given target price for any of the picks into this theme. So this is to be accumulated for, say, next 3 or 5 years kind of a time frame on an SIP system. And if I may continue with the other pack, was more to do with the stability of earnings. And that is why, LIC of India, Life Insurance Corporation of India, or General Insurance Corporation came into play, because there we are finding a good valuation comfort on the multiples basis. Business will continue as usual. I don't expect any miracles out there on the top line or bottom line growth. But even if they do what they have been doing, they are pretty, undervalued as of now. And other pick from this space was the banking space. I think banking is the only space which came out with the best set of numbers for FY24. I mean, 30% was an average PAT growth for most of these banking companies, with NPS coming down, NIMs being stable, and credit growth in the range of 15 to 17% looking forward. So the comfort was high, especially in the large cap space, and that was the reason why we selected SBC Bank. We have purposely avoided, Kotak Bank or HDFC Bank from the private sector space, and other PSU banks, smaller PSU banks, where the rally has been quite sharp. But these two banks are well capitalized. I mean, CD ratios are very fine. SBI, you have only 76% CD ratio, ICC 83%, and RBI governor highlighted this in their monetary policy, that CD ratio will be critical going forward for these banks and the NBFC space to can So these are the picks I think is likely to do well, where a mix of both growth and stability of earnings can be played out as a basket basis.
Okay, thank you so much for that, Dharmesh. Dharmesh, just one piece here, and I'm going to try to play devil's advocate. Just in terms of the run-up and the kind of forward valuations that some of these companies are commanding 3, 4, 5 years forward, of course there's visibility, there's no doubt, and likely there's execution potential as well, but it leaves very little risk on the table. So talk to us about what the risks could be as well of some of these railway capex plays which have really run up?
Yeah, Harsh, the only risk which I see to the entire theme, or in fact the entire economic, landscape of India is the political part. So right now, I think the marriage has happened, honeymoon period is going on, so you won't hear any negative news surrounding it. But given the historical weight of evidence and how I have known these parties over the last 20, 25 years, how they have evolved, this is very high. In case of an unstable government or some instability coming into the play at the center, maybe 3 months or 6 months down the line, then I mean, we are talking about, say, 3 years to 5 years kind of a time horizon for these play to sustain at these levels. So then there can be a risk factor playing out. So some delay in execution, something like that can derail the pace. But even if that happens, what has been committed will be there to stay. And from that point of view, the margin of safety is far higher in these companies than, I can take at least 100 mid and small cap names where there is no margin of safety at all. At least here you have a government backing to give you businesses on a regular basis. There you don't have even that. So that is where the selection is very tough in this kind of a market to come out. So we have given attention to more to margins of safety in this is.
Even the fact that you have so many PSUs. I mean, you just talked about the risks that you see with the government, etc. But yet you've picked so many PSUs ahead of the budget. I thought that was interesting.
Yeah, Tamna, but the very fact that these PSUs have, not much to do with the government functioning per se. So, I mean, if anything, structural reform has already taken place. It's just continuity of that with the same vigor. So if a budget has been committed on a PSU segment, in defense and railway, the things will flow in. But it's easy to, I mean, any interested convention of things like that from agri or farm. So that is where the financial space is getting impacted. We have known what has happened in the case of, say, microfinance companies earlier, like in Telangana, Hyderabad, what has happened a few years back. So these companies are at least insulated from any such kind of an environment. So that was the reason for selecting PSUs, and this is a risk factor. We are, playing our devils if it happens. If it doesn't happen, if things are managed and the present government is able to manage this opposition well, then I think these themes will play out the way they have been playing. So in the end of the day, in equity, if you are coming, and whichever basket you look at, nothing looks cheap to you right now. So some, leap of faith has to be taken, and we thought to take it on these counters.
Okay, right. Thanks for that, Dharmesh. Let's switch focus. We've been speaking at the Morgan Stanley conference especially with regard to banks, and are private sector banks better suited to tackle the RBI's rate cuts compared to PSUs is one of the many aspects and facets that we tried to cover. And we had Morgan Stanley's Sumit Kariwala who addressed this in a conversation with me. Listen to a slice of that.
When I look at large banks, and most of the large banks have 40 to 60% of the loan book linked to repo. So whenever RBI cuts rates, right now we're not assuming any rate cut over the next 1.5 years, but whenever RBI cuts rates, there'll be an immediate impact on all the banks. Okay, but banks, when you look at from a 1 year perspective, banks will be able to recoup a lot of that because the deposits will also reprice lower. But the point is that which banks will be able to manage that transition better. So if you look at private, they've been aggressively shifting their loan mix towards high margin assets. They've been very selective on what kind of assets they are cherry picking. Okay, and to that extent, what I see is that when I look at the starting point of margins compared to historical cycle averages, a lot of private banks have a lot of buffer. So there are banks where margins are 30 to 50 bips higher than the historical averages. Sure. This is not something which I see with the state-owned banks. And what will happen is that as you see a potential rate cut cycle, as you see competitive intensity kind of sustain, as you see deposit costs continue to move up, some of these banks will be able to retain their margins still above pre-cycle averages. And that would mean that the ROA, while it's moderating, it's still above cycle averages, and that's a good point. And when they're able to do that, people will say, okay, the ROA moderation for these banks is lower, these banks is higher. And to that extent, again, getting back to the point, that's where you see that some of that scarcity premium build up and reallocation from lower quality banks to high quality banks and so on. Again, just to be very clear, the lower quality banks could be in the private banking space as well. Understood. When I think about the smaller banks,
yes,
the smaller banks, the share of repo linked loans for them is not that high. Secondly, the smaller banks have higher share of wholesale funding. Not everybody, but a lot of them. And what will happen is that when you see a rate cut cycle, they will actually see the liability reprice faster than the larger bank. Sure. And to that extent, they'll be able to manage margins better. So the dynamics will change depending on the cohort we are talking about. But if I have to summarize in one line, there are a lot of higher quality banks which have margins which are much higher than pre-cycle averages. And those are the banks I would think can outperform.
Okay. So that was an interesting conversation that Harsh had today, and you can obviously catch that on our website and on our social media handles. But as we wind down, Rajesh, let me come to you, your BT-ST ideas for tomorrow, or STBT as the case may be.
It's all BT-ST stocks. First is Gujarat Gas. Stock managed to view breakout of flag pattern on weekly chart. The way stock has shown a long built up, we believe that Gujarat Gas may continue furthermore follow buying action in coming days, and possible target we can see towards 655 to 660. One can buy this stock with stop loss of 630. The second stock is Mazgar Dog. Very strong buying action is taking place. The way stock managed to view breakout of falling trend line on the daily chart, we believe that this stock can also continue furthermore upside. We are projecting target towards 3460 to 3500. Keep your stop loss to buy this stock around 3350. And the third stock where we are focusing, that is from housing finance, and Canfin Home is looking promising. Looking at the overall data structure, we expect this stock can also exhibit good amount of rally towards 845 to 850. Keep your stop loss to buy this stock around 809.
Okay, Canfin is one of the picks. Just before we wrap, Dharmesh, you talked about your top picks for the budget, but let's get a little more immediate. What about tomorrow? Do you see, these sugar insurance plays continuing, or is there anything else which is on your radar?
Yeah, I will pick up from where I just left. I think housing finance companies is in the watch for last 2 weeks, and it's likely to continue going forward as well. And there, I think Aadhar Housing Finance looks a good, not only a momentum buy, but a fundamental buy as well. Because if you look at the space, this is the valuation wise, the comfort is very high. It's around 2.5 times price to book value, where the same space, Aavas and Home First and all, they are trading at around 4 to 4.5 times price to book value. ROA is more than 4.2 for this company. And at the same time, it's the largest player in the space. Asset quality is very strong. And management sounded quite aggressive looking into the future, around 50-60% kind of a growth they are sensing. So my own sense is 410, 420 can be the immediate target as we head forward for the next couple of weeks. But if somebody is willing to hold it for a longer term, then 460 is our valuation price target on Aadhar Housing Finance.
Aadhar Housing Finance, remember, had a fantastic run-up right after the government formation, and the first decision of the government, which was to build 3 crore homes, and a sanction for that as well, the cabinet decision. So you've already seen that run-up. All right, thank you so much, Rajesh and Dharmesh, for joining us today. Pleasure as always to speak with you. Let's begin winding down closing trade today, and we have seen, and I just want to start actually with where we are looking like we'll end up above 23,400, which is not half bad, about 83 points up. So no firecracker kind of moves, but definitely a positive bias. What has worked today, and I have to make a mention of the Nifty IT. Let's just pull up the Nifty IT before we go into the heat map, etc. Over 1%. We can pull up the internals as well, the components of the Nifty IT, and see what's working there. Because your basically Fed Reserve boost has carried on. Will it sustain? Well, that's anybody's guess, but perhaps not, because you've seen a very up and down kind of movement for IT stocks last few days. Emphasis, though, is the star today, about 2.5% up. In terms of sectoral indices, and I'll pull that up as well, apart from IT, I think reality has worked fairly okay, PSEs as well. On the losing side, you don't have too many. Media, FMCG, I mean, with small components. FMCG definitely in pain. I want to pull up the heat map as well for you and just show you what the day has been like. And not too many changes there right on top. Shriram Finance with a last-minute boost. A lot of fuss for Shriram Finance which have come in, whether it is market cap crossed at a record highs for the stock as well. So Shriram Finance doing well. HDFC Life has been up there very, very positively, and again you see the IT stocks there, LTI Mindtree, etc. L&T has seen a solid run as well. On the losing side, you have HUL, Britannia, Tata Consumer, some of them, even some of the banks, I would say, Harsh, not doing too well at all today. Axis, ICICI Bank running out of steam. ITC also a bit in the red. On the broader markets though, and I just want to get a sense of that. It's been relatively okay, but the action with sugar and insurance, isn't it?
Well, yes, sugar, insurance, defense, Tamanna. Defense has done very well as well today. So those are three possible pockets which we can try to quickly pull up as we wind down. Sri Renuka, of course, but can we pull up a Praj? Can we see where that one is probably settling? And there you go, 8% higher on Praj as well. So some of those counters doing well. Let's pull up a BDL. Let's pull up a Garden Reach, which was up 12% plus the last we checked. And there you go, nearly up 15% now, Garden Reach.
Just to add why that's happened. So Rajnath Singh took over as officially as Defence Minister once again for this term, and emphasized two things: Make in India, and saying that defense exports will be at levels never seen before. So that's some of the reasons you're seeing defense back up today.
Yeah, the entire defense counters, or pretty much all defense counters in fact. So that, but let's pull up the BSE 500, get a texture of some individual names which are doing well. Something like, at least within the losers, you'll see APL Apollo really stand out. Outside of that, Sun TV also down and out after, of course, it gained yesterday, so that's the positive, but seeing a bit of a correction today. Sanofi one can ignore because it's gone ex demerger. But outside of that, let's look at an Oracle Finance that's up 11%, Aegis Logistics up 9%. So some names really doing well in trade. Paytm, partnership with Samsung, up almost 7.5%.
Oracle Finance also up today because their parent company has posted stellar numbers. So that's why you're seeing Oracle Finance up. Delta Corp, I would guess the GST first council meet dates are up. And remember, pending things from last term, one of them is the gaming taxation. So maybe that's why you're seeing Delta Corp up. And of course, all of sugar stocks were up, so Sri Renuka as well.
Yes.
Paytm, I don't know how many people use a Samsung wallet and how many will use Paytm. So revenue accretive, we'll have to see, but the mood definitely has changed. But really, that's all the time we have this afternoon. So from Harsh, me and the entire team that put the show together, thank you so much for watching, but stay tuned, a lot more coming up on the other side.
Look, while you are trying to get...
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell.
Whether it's a doubt about a short-term trade
or a long-term investment,
all you have to do
is ask Profit.
Bro, what are you doing?
The insurance regulator issues a slew of consumer-friendly rules. Now you can surrender an insurance policy and get back the premium due. No questions asked. Nifty and the Sensex register record high closing as the market extends its rally for the third consecutive session. Finance and IT heavyweights lead Nifty's rally. Prime Minister Modi leaves for Italy to attend the 50th G7 summit, his first international trip after assuming office for a third term. The GST Council meeting will hold its first meeting under the NDA 3.0 on the 22nd of June. Key issues such as GST and online gaming remain overdue on the agenda. The controversial grace mark stand cancelled for over 1,500 students in NEET. If any of these students wish to take the NEET exam again, they can do so on the 23rd of June. The Supreme Court is yet to address the allegations of question paper leak and illogical scoring. The new aviation minister vows to make air travel affordable for the common man, says he will bring down sky-high ticket prices. The Kerala government announces an ex gratia of 5 lakh rupees for families of the deceased belonging to the state in the Kuwait fire. Kerala Health Minister Veena George will fly to Kuwait to coordinate treatment for the injured and to help bring bodies home. Good evening, you're watching The Reporter on NDTV Profit. I'm your host Pallavi Nahata, and as always, the show aims to bring to you market insight along with national and international news. Now, the insurance regulator has given more freedom and flexibility to policyholders. You and I can surrender or close an insurance policy at any time and get the full refund due. The regulator has also said that no refund can be rejected on the pretext of lack of documents. Earlier, the IRDAI had directed the health insurance providers to settle cashless claims within an hour and to provide authorization for discharge within 3 hours. It has also directed insurers to have a physical help desk at hospitals so that claims can be settled quickly and smoothly. Now, these are the latest in a slew of consumer-friendly directives issued by the insurance regulator. Now, we have Poonam Rungta, CFP, who joins us on the show to share more on what the latest directives mean for the consumer. Poonam, hi. Thank you so much for taking time out.
My pleasure. Thank you.
So, the IRDAI has come out with a slew of pro-consumer rules in health insurance as well as the life insurance sectors. What has prompted this?
This, I think, was long awaited because certain rules and regulation and the compliances which goes with the insurance policies were not gelling with the new age investors and the people who want to make a complete portfolio. So due to the liquidity was the main issue, I think, of all the things. Because as you primarily know, other than term insurances, what other conventional products we have other than ULIPs? So there is a term insurance, which is a type of insurance which is a pure vanilla insurance, which doesn't have any rocket science, as in where other things are concerned. It's a pure insurance, so that is a separate thing. In that also a lot of changes have taken place. And then there are ULIPs, which are connected with the markets, which are also in a different ball game where insurance is concerned, where investor want an insurance come investment, so they go for ULIPs. But when it comes to the traditional policies, the conventional policies, which has a lot of other return on investment kind of factors involved, as in the bonuses, the loyalty bonus, the final additional bonus, and most of it is the longevity and the lock-in period. So if somebody has taken a conventional policy with the aim of investing in it, then the investor gets locked. His money gets locked, because when he wants to surrender the policy, the liquidity is very low. In case of any emergency, medical emergency or other family emergencies, you cannot withdraw the money, and if you withdraw, you end up making losses. So to bring the innovation in the Indian insurance industry and to have more penetration of these products across the country and in the new age investor, in the youth. So this type of changes were the need of the day, because slowly some changes have been happening gradually. The shorter premium paying term, which the investor wants nowadays, nobody wants a longer term. So as the investor need is, the IRDA make changes. So now we have limited premium paying term, shorter paying terms, and all of these things together made up to this fact that certain basic changes which were not made for a long time has to be incorporated for better penetration, innovation, and most of it to curb the mis-selling, the major problem in the insurance industry.
Right, Poonam. So, you've spoken about some of the challenges that the consumers were facing. So, did the IRDAI get feedback from policy holders before they initiated the slew of these recent reforms?
Yeah, so IRDA is basically the regulatory. How we have a regulator for the stock market as a SEBI, IRDA is a regulator. So it regulates basically, it works for the consumer's benefits and its better transparency of the product and to curb the mis-selling. So on the various feedbacks and the need required time and again, and the kind of complaints it used to receive from the investors, it came up with these changes, which is also the need of the day. So IRDA works for the benefit of the consumers primarily, so it came up with these changes.
Right, Poonam. Can you tell us a little bit about what policyholders can